My name is Andy Agathangelo. I am very proud to be the founder of the Transparency Task Force. The Transparency Task Force is a collaborative campaigning community. We don't really think there's anything else like us anywhere in the world. We think we're pretty unique. Whether we are unique or not, we are definitely known for trying very, very hard, as best as we can, to make real change happen within the financial services sector. Our mission is very carefully defined. It's carefully defined because our mission is a formal part of our constitution. It is a part of our status as a social enterprise that we have a mission as follows. Our mission is to promote ongoing reform of the financial services sector so that it serves society better. That's what we're all about. We operate through many different groups. We have groups of people focusing on, for example, foreign exchange, another group focusing on issues relating to banking, another group is focusing on issues to do with investments and other pensions, so on, so forth. And this particular event this evening really straddles two very important groups. We have one group which we call Scam Busters. It's made up mostly of scam victims, plus others who are very interested in helping to alleviate the scams problem. And the other group that is relevant for this evening is the group that we call Regulators Watch. And the reason we have a group called Regulators Watch is that we believe we cannot have a financial services sector supporting and serving society properly unless we have a regulatory framework that works. And we don't think we've got that. We don't think we've got a regulatory framework that works. Too many people are suffering too much harm, in some cases, life-changing harm. And when we've looked at the issues, we've very simply come to the conclusion that there's a lot that the regulators could do better than they do now. And that is why the Transparency Task Force has been very, very focused, particularly in the last 6 months, at this whole question of regulatory failure, regulatory capture, whether, for example, the Financial Conduct Authority is fit for purpose. Now, this has nothing whatsoever to do with any kind of agenda or personal issues. We're just looking at things from a big picture perspective. We're seeing lots of people being scammed and harmed by crooks and criminals. We're also seeing regulatory conduct that we think is not good enough. And that's not just our opinion. These kind of points are borne out very, very clearly by independent reports. For example, the independent report by Raj Parker on the Connaught Series 1 scandal. For example, the independent report by Dame Elizabeth Gloucester on the LC&F bondholders issue. And all of this does point to the idea that the regulators are struggling to protect consumers from harm. And given that consumer protection is one of the most important functions of any financial regulator, this we recognize to be a very, very serious issue. There is so much that we would like to cover this evening. We are having to be pretty kind of focused on what we are going to be covering. And I really do encourage you all to not just think of this event as some kind of, seminar. It's actually part of a strategic plan to galvanize support for the kind of positive, progressive, and purposeful reform that we want to see. And what I'm going to do first of all, ladies and gentlemen, is I'm going to draw your attention to something that will give you a feel for just how big the problem is. How big is the problem relating to financial services misconduct? Now, some of you may know that the Transparency Task Force is a huge, huge fan of something called Violation Tracker. And I'm going to share my screen so that you all know about Violation Tracker. Here's Violation Tracker. It's a United States database. I say it's a US database. I'll come back to that point in a moment, but it's essentially a database that's conceived and created in the United States of America. And what it does is it tracks violations. It really couldn't be any clearer. What's absolutely fascinating about this database is just how big and powerful it is, how comprehensive it is, and frankly, how useful it is for anybody that wants to point to hard evidence that there is something seriously wrong in the way the financial services sector is operating. And let me, ladies and gentlemen, show you why. If I click on the bit called largest penalties, it takes us immediately, it's a great database, it takes us immediately to the list of companies who've been fined who've been fined in the United States. So these are all companies who have in some way broken the rules. You'll see that BP is number one. In the fourth column in from the left, you'll see that they are the top performing violator with an environmental violation. So this is about oil pollution and that kind of thing, I guess. It occurred in 2015. Number two is Bank of America. Number four is JP Morgan Chase. Number five is UBS. Number six is Bank of America. Number seven is Bank of America. Number eight is Bank of America. Number nine is BNP Paribas. Number 10 is Countrywide. So if you look at the left-hand column, ladies and gentlemen, what you'll see is that in the list of worst behaving companies, as determined by the amount of fines against them, look how frequently financial services comes in. It's a huge problem. The financial services sector, based upon not just this database, based upon, for example, the evidence stored in the Edelman Trust Barometer, the financial services sector seems to have a predisposition to behave badly. And this is hard data. All of this information I'm showing you, ladies and gentlemen, is based on hard numbers of fines in real courts against various federal agencies in the United States. And to make the point even more powerfully than I just have, let me show you this. If I click on this bit here, industry totals, we get the listing of all the industries. The one at the top, I'm ashamed, embarrassed to tell you, is financial services. Now, this is horrific. That's a strong word. It is horrific because, think about it, the financial services sector is built on the idea that it can be trusted. The financial services sector is built on the idea that it can be believed in. The word credit comes from the Latin word credere, which means believe in. Yeah, you know, people enter into financial arrangements with each other, between people, between organizations, between an individual and an organization, or an organization and an individual, because they believe the other party is going to behave according to the arrangement, the contract. So you have to ask yourself this question. If we take trustworthiness out of financial services, what have we got left? Not very much. Not very much at all. So I would argue, in all honesty, that the financial services sector should not even be in the top half of this table, let alone the top quarter, let alone the top. But look at the numbers. Look at the size of the issue that we've got here. The total amount of fines against the financial services sector, against US agencies, US government departments, etc., such as the SEC, the main financial regulator there, 331 billion, not million, billion, 331 billion. That's bigger than some countries' gross domestic product. That is a massive, massive number. In fact, it's so big that you've got to add up all the malpractice, malfeasance, misconduct, and mis-selling by the pharmaceuticals industry and the oil and gas industry and the motor vehicles industry, etc. I think you've got to work your way down quite a long way to add up all the numbers of all these other industries until you get to the financial services sector. And so that is why when I gave a speech on the 6th of May, 2015 at Senate House, London University, about the urgent need for financial reform, I was right. We were all right. Everybody that was saying there is something really bad going on in the financial services sector, we were all right. We were all right to be saying that. The evidence stacks up here. There really is something wrong in the financial services sector. But look at the detail. If we now go to the next level of detail, we click on the financial services bit and we get a very detailed breakdown of the worst offending companies. How embarrassing is it that we've got the Royal Bank of Scotland in the list of the top 10 financial services institutions in America for infringements? How bad is that? I mean, it couldn't get worse. But look at this. When you look at the detail, so what you're looking at now, ladies and gentlemen, are the individual fines against individual financial services companies. Can you see the pattern? The same organizations are being fined for the same things over and over again. And there is a word to describe this. The word is recidivism. Recidivism is when an individual or an organization does something wrong, gets caught, gets told off, gets prosecuted, fined, whatever, gets sent to detention at school, whatever it is, and carries on doing it. And this is the worry. This is exactly the worry. I'm being really precise. The worry is that the idea for a bank, for example, it's not just banks, the idea for a bank that getting caught doing something wrong and paying the fine, the evidence suggests there's recidivism. That suggests it's almost becoming a cost of doing business. It's somehow acceptable. Of course it's not, because people suffer when banks and other financial institutions break the rules. Not just financially either. The global financial crisis. I'll put the link to the point I'm about to make in the chat in a moment. The global financial crisis, as well as it causing massive economic carnage around the world, it also led to over 10,000 people, according to research by Oxford University, published in one of the major medical journals. It was actually about depression. The global financial crisis caused a lot of depression that caused, it's documented, it's researched, over 10,000 people to kill themselves. So we aren't just talking about numbers here. We aren't just talking about abstract ideas. We're talking about real human beings having their lives shattered, ruined, wrecked, mums, dads, brothers, sisters, sons, daughters, lives wrecked as a direct consequence of malpractice, malfeasance, misconduct, and mis-selling in the financial services sector. And that is why, ladies and gentlemen, I personally made a decision a while ago to stop being a entrepreneur, let's make some money kind of guy in the financial services industry, to make the brave leap of faith to become a full-time campaigner for reform. Last point I'll make about violation tracker before we move on is this. We're copying Levi, Coca-Cola, Jimi Hendrix, and a few other things. Great American products that have successfully crossed the Atlantic come to the UK. If you don't already know this, believe me, I'm so proud. For over a year, the Transparency Task Force has been working very, very hard. And I do mean very, very hard. We've got no money, so everything for us is really hard work. You know, trying to do what we're doing if we had a lot of money would still be pretty difficult, in all honesty, but we're doing what we're doing on buttons. We're bringing Violation Tracker to the UK. We've got the backing, we've got support. Now, Violation Tracker is like an MRI scanner. Yeah, it's like an MRI scanner for poor corporate conduct. It's like an MRI scanner that hunts out the cancerous, corrosive conduct, not just in financial services, but right across all industries. And we, little old TTF, running on a shoestring, never sure how to pay next month's bills, we've brought it to the UK. And what that means, ladies and gentlemen, is it's like we've obtained a great big spotlight that's going to shine a great big bright light on all the malpractice, malfeasance, misconduct, mis-selling in the banking sector and all other industries in the UK. Not just financial infringements, but everything, environmental infringements, employee rights infringements, the whole shooting match. This, if we achieve nothing else, if the Transparency Task Force achieves absolutely nothing else, we would have been worthwhile. Believe me, that's how significant this is. I'm going to make one more point before I'm going to pass over to my wonderful colleague, Alexandra, who runs all of our events. This is, I think, the 23rd or 24th event we've run. You know, it's absolutely amazing what we as a teeny tiny team are doing as a consequence of the work that Alexandra and her colleagues are doing. I want to share something with you, which I think is wonderful news. It really is wonderful news. So, share screen. What you're looking at now, ladies and gentlemen, is a web page. It's a web page of a crowdfunding site called Crowd Justice. And to be more specific, it's the crowdfunding site for a campaign all about Mark Wright and Steve Middleton. And this crowdfunding campaign is about raising money from the people to put their pennies and pounds together to have enough money to challenge the banks that caused the global financial crisis, etc. But not just the global financial crisis. They've quite simply caused many individuals in our country a lot of harm, and you're going to be hearing more about that shortly. And I'm really pleased that it's got over the initial £5,000 threshold, which is wonderful news. I think, ladies and gentlemen, that there's a chance that this very significant campaign, and I'll explain why it's so significant in a moment, there's a chance that this campaign could achieve its £7,500 stretch target, because we've still got 16 days to go. And if you do the maths, it's doable. All we need is enough people to put in whatever they can afford. It might be a little, it might be a lot. If we get this as £7,500, it will mean that the guys have got the resource to do what they're trying to do. What are they trying to do? They're trying to expose a whole load of stuff that should never happen, a whole load of stuff that it would appear has been covered up. They're trying to expose dishonesty and misleading information. They're trying to expose the very things that are at the heart of the rot of the financial services system in our country. And also, I would argue, they're going to expose the need for radical, progressive, purposeful reform of the financial services sector. So in a moment, I'm going to put the link to this website in the chat. I encourage you all, please, at the very worst, just read the webpage. Read the webpage. Understand what the issues are. If you're inclined to make a donation, that's wonderful. But do this at least, please do this at least. Read the webpage and use social media to draw as many people's attention to this webpage as possible. That's my ask. Two things. Read it. It will take 10 minutes, and share it on social media. I'm now going to pass over to Alexandra, who's going to take care of a couple of housekeeping points before we quickly move into our stacked and seriously important event. Alexandra, over to you. Thank you.
Hi everyone, I'm Alexandra. I'm the head of events at Transparency Task Force. So just to let you know, we are recording this event and it will be uploaded to our YouTube channel. We try and do it as quickly as possible, but obviously with Easter coming, it'll probably be up early next week, but I'll send an email around to everyone who took part to let you know when it's available. Also, any notes you put into the chat, I will circulate in a follow-up email. And also, if you could just help us during the symposium, if you want to tweet anything, please do, and please use our Twitter handle. I'll put that in the chat. So I'll be here the whole time, but I'll have my camera off. But I'll be here and I'll be looking over the chat. So if you need anything, just let me know.
Wonderful, Alexandra. Before we do anything else, and I know it's a team effort, it's not just Alexandra, but can I please ask you to do something for me? I reckon TTF's got the best little team going. I really do. Can I please invite you to just put your hands together and thank Tina and the team for doing what they do? You know, there are great big organisations with big budgets have not done 22, 23 events so far this year. We've had about 900 people come through our doors already this year. And we are working so hard. I'll chip in every now and then with some various other things, but what I'd like to do now is pass over to somebody who's an absolute superstar within the TTF community. He really is, Mr. Andrew Candy, or I say Andy Candy. Over to you, please, sir, to share with us whatever you'd like to say. Thank you very much, Andy. Thank you.
So there we go. Thanks very much, Andy. Very much appreciated. I'm really pleased to be here this evening. Like to extend my thanks to you and Alexandra and the TTF team for making this possible and for actively promoting it, and for all the work that you're doing and hopefully that can be achieved in the future. I'd also like to extend my thanks to the speakers in advance, not just for their time this evening, but also for their dogged determination to keep shining a light on these critical issues which have been buried and kicked into the grass for a ridiculous amount of time now. The information these guys have shared with me over the past 2 years has really opened my eyes to the abhorrent nature of what was perpetrated upon swap victims and RBS GRG, Lloyds BSU, you know, the list goes on and on. It's quite sickening, really. I myself has worked in the creative and strategic roles across the design and marketing sectors for over 25 years. Just to give you a bit of background of how I got into this, I'm currently the owner of Tentacle, which is was a successful design, branding and marketing agency. And then I also set up a cooperative art craft and design gallery. The demise of my business over the past decade was irrefutably brought about by the proven and accepted mis-selling of a catastrophically damaging interest rate hedging product with undisclosed and hidden margin credit facilities and risks by HSBC in 2008. Since 2009, I've been forced to battle for justice, fair treatment and restitution for myself and fellow IRHP victims, which I've tried to do by bringing my evidence and legitimate complaints to the highest levels of HSBC Bank, including within the past year under whistleblower governance and under the auspices of the bank CEO, Ian Stewart. And here I am still more than a year later, still plodding away. Unfortunately, as a result of HSBC's negligence and gross misconduct, I've also had the distinct displeasure to have been forced to engage in the further damaging and time-consuming process of bringing my legitimate complaints these past 10 years. And it's bad enough what the bank do to you with the products and the mis-selling and everything else, but the damage that is wrought by the process of bringing that complaint is equally, if not more damaging. The time that it takes, the stress that it causes, the lives that it takes is truly shocking. I've had to go through the Financial Ombudsman Service, the Independent Assessor, Financial Services Authority, its supervision enforcement teams, Action Fraud, City of London Police, Metropolitan Police Financial Crime Unit, critically flawed FCA IRHP review and address screen, which was a total shambles. The former FCA CEO Andrew Bailey and the former FCA Complaints Commissioner Anthony Townsend. I have to say that the unprofessional, negligent and disruptive behaviour of staff with whom I've engaged at every level within all these organisations has been a truly traumatic and shocking experience, and sadly one I share with thousands of UK SMEs. Our collective experience and evidence is a damning indictment of the way banks and regulators and the establishment treat small and medium business owners, and especially those seeking full and proper restitution for proven mis-selling by the UK financial and banking sectors. The damage this causes to the wider UK economy is staggering. It cannot be allowed to continue and needs to be urgently addressed and resolved. I very much hope that the content of this evening's event proves to be a keystone in that process. I very much hope that and expect the TTF to be a significant part in that from the work that they do and what they've achieved so far. And I'd like to thank you all for attending on a pre-Easter bank holiday weekend, and hope you find the information that the experts will share with you enlightening and of use to your own individual cases, and for the journalists, maybe something you haven't quite heard before. I'd ideally like to hand back to Andy now to introduce Steve Middleton. We think that it's most important that we focus on the detail of this that Steve's been, you know, doggedly fighting away to expose over the years, and hopefully it'll be a benefit to all of you. So that's my little bit done.
That's more than a little bit done. That's your great big bit done. Thank you very much indeed, Andy, for giving yourself the cause as unselfishly as you have done over a long period of time. It's become a very genuine pleasure to know you in every way. Thanks, Andy. Thank you very much indeed. The lineup of speakers is as follows. We're going to have Steve Middleton, then Paul Carlier, and then Dave Glynn, then Hester and Martia. Forgive me if I've not pronounced those last two names very well. Then after that, we've got short sessions. We call it the just a minute rounds. We've got Peter Crowley, Craig Beavers, Clive May, and Andy Verity. Andy Verity, as in Andy Verity, the Andy Verity, BBC. So great that you're all here. Let's get stuck in. So Steve Middleton. Steve, please do all you can to stick within the kind of time frames we've kind of looked at, and let's go for it. I will be keeping the channel open after 8 o'clock for those that want to hang around and natter afterwards. That's fine. We'll keep the channel recording after that time as well, in case anything comes out that's particularly useful. But let's try and get as much of the actual formal part of the program done and dealt with by 8 o'clock. Mr. Middleton, over to you, sir. Thank you very much indeed for sharing with us what I think is likely to be rather interesting. Thanks, Steve. Over to you.
Right. Thanks, first of all, to Andrew for that informative introduction. And thanks to Andy and Alexandra and the team at Transparency Task Force for arranging this. They put a lot of work into putting it together and promoting it. And I think these are still very important, outstanding issues that need to be considered. I've been saying that this issue of hidden margin credit is the biggest financial fraud in recent history since 2013. Here I am in 2021, still trying to expose what really happened to people who bought these swap products, and how many of them lost their businesses, and some of them even their lives, because of risk they were not made aware of. So I'll try and move through as quickly as possible. If I'm dragging on too long, just wave at me and I'll move more quickly. So we'll move to slide number 2. So what were swaps? Keep it very simple. Think of PPI for SMEs or business people. You were buying a loan and you were sold an insurance at the same time. Banks were going to collect the insurance along with your loan payments when you took out this protection, as they called it. The protection, unfortunately, just like PPI cover, was never intended to pay out. There were huge balance sheet benefits for the bank, and they were the opposite for SMEs and business people who had huge credit liabilities put on their businesses that they were never made aware of. It was a sales scam, but a far more dangerous one than PPI. So what is an over-the-counter interest rate swap? When we say over-the-counter, we mean it's a bespoke product. It's not something you can go into any financial operation and buy. You can only buy it from the bank you're dealing with. It's not a loan product. It doesn't protect you against interest rate risk. Some people will say that's controversial, but I'll explain why as we move through the presentation. It's not a no premium product as it was sold to many people. And the risks were not unknown. The bank knew about the risks and the potentially higher risks. You were just never made aware when you were sold these products. What an over-the-counter swap is, it's an investment contract. You're basically taking on a long-term gamble against the bank on where base rates, bank base rates or LIBOR rates will go. As I said, it's a bespoke contract. They were mainly sold in their tens of thousands for a few years before the credit crunch, and then avidly for several years afterwards. You were encouraged to swap your variable rate of interest for a fixed rate, somewhere at or around current rates, by a banking expert. Later on, when you complained that you were advised to do this, you would be told they didn't advise you. To get out of the swap, in theory, there could be a gain or a penalty, which is what most people were told. But the bankers would tell you, in general, we can't really tell you what the amount could be. It could be substantial. So most people entered into these with no real idea of potential penalties or potential gains. Ultimately, it's a high-risk investment. It's a multi-currency cross-border deal, which should only be traded, these swap trades, by professional investors or counterparties. You trade the swap under an ISDA master agreement. That's an international swaps and Derivatives Association Agreement and their rules, except the majority of people didn't know that because they never saw a master agreement. But simply, when you entered into a swap, you entered into a head-to-head bet with a bank who you're lending money off. Party A, the bank, party B, you, the customer. What you were losing was their gain and vice versa. The bank, on their side, have their economists in-house and externally, global investment experts, derivative traders, Bloomberg systems globally. They're involved in the LIBOR panel setting interest rates, and they have access to the Bank of England. What you had to rely on if you were buying a swap, the bank's own treasury expert. Now, the bank may well say, well, you could have taken advice elsewhere, but how could you? This was a bespoke product, so don't only buy that bank and set up only on the terms the bank chose to set it up under. Again, just to reiterate, every pound you lose on the trade is a £1 profit for the bank. It's a bespoke deal. Before you entered into the deal, there would usually be two firms involved on the bank side or the banking group side. They will calculate your losses on the product and their potential gains before they sold you it. The higher your losses, the higher their gains, and the higher the commissions they received. A bank manager would apply for and get approval for an undisclosed or hidden credit facility covering what they expected your losses to be. So you're basically buying an investment that will lose money from the bank who will make the money you lose. And because they're so kind, they're actually going to lend you that money for the losses, they just won't tell you about it. This is something called margin credit. Again, just to reiterate, it's a heads I win, tails you lose bet. Well, why would you go into such a bet with a bank? Now, there's quite a lot of information on some of these slides, and I may skip through them, but obviously they're on this site tomorrow. So if there's anything particularly you're not sure about, please just come back to Andy or Andrew Candy or myself, and I'll go into them in more detail. But effectively, from late 2007 on, the banks were selling trades where they expected the customer to lose. Banks would offer you a higher rate or a current rate that seemed quite reasonable at the time because they expected rates to decrease. And don't forget, the banks are responsible for LIBOR rates and they're responsible for their own bank base rate. The Bank of England, which protects the city and the banks at all costs, control base rate. So you're up against the whole system. What if rates had gone up? Then the bank could rely on vague clauses in the swap and loan contracts to close out the deal. You wouldn't win either way. Now, this is a very simplistic graph that I've put together, but it mirrors quite closely a trade that one of my first customers took on, and he'd taken on a 10-year swap. It was a complex deal, but roughly fixing him at around 5.25% at a time when rates were between 5 and 5.5%. So at the time, it didn't seem too onerous. But as he was sold that trade, the bank itself had projected that on this 2 million 10-year trade, they expected him to lose at least £270,000. How do we know they expected that? The bank will normally tell you, well, we don't know what your losses could be, we can't work it out. Well, that's exactly the opposite of what they've done. When you enter into the trade, which you do through an irrevocable telephone call, as if you're an international trader, you actually get a confirmation to sign and send back. Now, in all fairness, once you've done the telephone call, you've done the trade. As I say, it's irrevocable. But if you look at the page on the screen here, this bank here, which is NatWest and the banks at NatWest, the trading company, are RBS, they've produced a 2-page confirmation. The first page is very simple, tells you how the swap works, who the parties are, and what payments you make. The second page is the interesting one. That has something you can see there. I've got a circle around called contingent liability. That is the amount that the bank have calculated they expect you to lose over that 10-year term. They'll talk about it being their risk, but in reality, that's your expected losses. And if you look at the bottom, 47,000, that is the actual day one AV, added value, or effectively commission that they're making from selling you that product. So if we go back to that simplistic graph I put together, how did this affect the same customer in 2010? Well, rates had obviously gone flying down much further than the banks expected. So where the banks had projected a 270,000 roughly profit previously, they were now projecting in 2010 that he was going to lose around £500,000 on the swap deal. So that was what they call his contingent liability. That's what the profits they expect to make. That's what he will pay over and above the variable rate over the term. So was it a real liability, or was it, as the banks will keep saying, contingent? Well, this is what the customer would see in 2010. The customer would be looking at his bank statements or any printouts from the bank, and he would see that on this occasion, the customer had about 3.5 million in property. He'd been downvalued in 2010 to 3.15, but his loan was 2.38, or his loan and his overdraft. So he thought he was okay. He was at 75% loan to value. Usually below 80%, you're safe with the bank. But what does the bank's credit system say? The bank's credit system would show these figures in 2010. The same debt, but they had a 0.47 million credit line liability as well on top of that loan, and the value of the property at 3.15. According to the bank, he was at 91% loan to value and therefore in breach of his terms. Can we prove that's true? Yes, because this is a redacted copy of the email from the bank manager to the customer. It was very unusual for a bank manager to actually make this kind of admission or give you these figures. This is extremely rare communication. But on this occasion, the bank manager went to the customer and told him all of his liabilities. So he goes to him on 10th of September 2010 and says, "Good afternoon, hopes all is well. We've had the valuation, so he's saying, assuming it's the best that can be achieved, we're looking at a position of 3.15 million, your total security value. You've got 2.38 in loans, 0.47 billion in hedging liability." Now, this is the first time that the client had ever heard a discussion of that as a real limit or a risk or a liability. Previously, all that had ever been told him was that there was a break cost they couldn't really calculate. So they put his debt at 2.865 million, loan to value 91%. What does the bank manager say? Am I missing something here? The position has been skewed considerably. My concern is at this level of gearing, the bank will want to pass on control to GRG. And that's exactly what they did. Within 4 to 6 weeks, he was in GRG and fighting to save his businesses. Again, if you don't think the credit facility is real, this is another case that Ben Chapman from The Independent did an excellent story on. It was a GP practice who had a 100% loan to value loan at just under 5.3 million. Now they'd been sold a 25-year swap. So they just had a credit line increase approved here. And you can see that the credit facility, B2, is almost 3.5 million. Now, again, the bank will try to say, don't worry about that. That's our risk, not yours. But if you look at the wording, the total direct exposure for the connection is 8.7 million. It's not 5.2, it's 8.7. And there are notes within the credit files on that case where the bank managers are discussing with credit that if they break the swap, and even if they sell the surgery, there will not be enough equity left over if the GPs sell all of their assets to repay the liabilities. And it will likely lead to the bankruptcy of 4 GPs and a practice manager and probably the end of the medical practice. Now, I would call that a real liability. So how did generally smart, intelligent business people end up buying these products that were doing them so much damage? Well, I would say because ultimately you were conned. It was a scam, a setup, a sting, I would call it. And I've accused the banks of that at every level, and they refused to respond to my concerns over it. But what would happen is you would have your friendly bank manager come along, and he would be offering you teaser rates of 1.25 over base, 1.5 over base, rates you'd never heard of before. You'd get offered low setup fees. He'd offer you extensions you didn't think you would get. He'd consider taking old valuations that you had or estate agent valuations, all of which encourage you that the bank were really there to look after you. But what he'd tell you is, we're quite concerned because, things have been good for a while. It looks like there may be a downturn. Do you remember those bad old days, 12% interest rates? Well, we're quite concerned about that. We're happy to support you, but you may want to protect yourself. I'm not an expert on this, but I know somebody at the bank who is. So then comes the convincer, the treasury expert or the market trader or the market representative. And he will tell you, yeah, there are ways to protect yourself. He won't talk about current rates over the last 2 years or projected rates over the next 18 months or 5 years. He talks about the last 30 years or the rates since the Second World War. He tells you the average is 9%. He said, look, we've got these expensive products called caps we can sell you, but they're quite a big premium. But we have this no premium option. So you don't have to pay anything for it. It will offer you some protection if rates go up. There may be some kind of penalty when you come out of it, but we can't really tell you what that is, but it's a beneficial product. Now, what they didn't tell you, that person did not work for, in this case, NatWest Bank. They worked for an RBS markets firm. they were a separate financial services firm, just the same as NatWest Bank is a separate financial services firm and bank. The RBS firm will make a substantial commission from the sale, and they'll share that with NatWest, and the bank manager will get a share. They know what your expected losses are going to be over the term, or what they plan on them being or expect them to be. Look at that 270,000. They've already told your bank manager, if you're buying this, to put in place a credit line to cover those losses. So on the case I showed you, without his knowledge, that person, the minute he took on the swap, or prior to him taking on the swap, had a £300,000 credit line in place he'd never been told about. That was part of his loan to value and secured against his assets. They'll talk about rates going up. They won't tell you that their forecasts say rates expected to go down long term. And as I've said, they won't talk about how they could lend you money for a cap rather than lending you money for margin credit for this incredibly high risk product you're going to take on. So what happens? The customer believes the bank manager, he believes the trader, he thinks he's taking on a 2 million loan. He's got his factories worth, say, 3 million. So he knows he's putting his title up for that liability. What he doesn't know is he's also taking on the additional liabilities. And because he hasn't restricted how he's passing his title to NatWest, they have an awful lot of leeway in how they treat his assets. What he will complete, or that person will complete, or the business person, is the debenture. And that debenture will cover all group liabilities, not just a NatWest. There'll be an all-monies charge covering actual and contingent liabilities. So what's happened? Well, again, the customer thinks he's had a 2 million loan. He's actually borrowed 2.3 million. He just hasn't been told about the 300,000 liability. He's given his title to the bank until he pays his loan back. But because he's entered into this ISDA agreement, this complex investment agreement, what he's done is actually given his title to the bank without restriction. So because the bank is allowing him to have this trade and the loan for that title security, that bank can then pledge on the whole value of his assets to its broker, RBS. So effectively, you've just put all of your assets up as an ISDA trader to NatWest, who will pledge them onwards to cover its own liabilities in the market. And at the time prior to the crunch, the average time customers or the bank's assets were leveraged. And when I say leveraged, if you think about all the criticisms of people who had Northern Rock mortgages, having that ridiculous 125% loan against 100% value on the home, leverage at the bank in this case is where on average 400 to 500%, roughly about 4.5 to 5 times the values of their assets. So your factory could be there pledged to RBS with 15 or 20 million debt against it without your knowledge. And just to, on that point, I think it was the FSA's report that suggested at the height of its troubles, before it was bailed out, RBS or NatWest markets were leveraged up to 42 times their assets. So do the rules allow this? Well, frankly, no. The Financial Conduct Authority rules and the conduct rules, which many of you might have heard of something called COBS, they tell you when you're selling these products to a retail client, you have to make them aware of margin credit. You have to make them aware of leverage risk. You have to make them aware of contingent liabilities so they can make an informed decision. And why is that? Because the same rules that the FCA put forward under their asset protection rules will tell you that the banks can treat products caught up in these ISDA deals as if legal title and associated rights have been transferred to the firm who's lent you the money. And you'll see there examples of arrangements covered by this chapter, including the taking of collateral by a firm under the ISDA English law transfer of title. So effectively, there is a huge risk with these products. You should never have been sold them. So clearly in the review, you should have all got all of your money back and all of your consequential losses. Well, that didn't happen. Why? Because again, the review was set up on a sham basis. It was set up as a point of sale review. Credit lines had to be put in place before you ever did a trade. You couldn't actually take on the swap if you didn't have the margin credit in place. So under the review, the credit lines were not considered. The rules on contingent liabilities were replaced by softer, lower level sales standard rules. These focused on break costs, which could be on a shorter trade the same as contingent liabilities, on a longer trade half or only a third of the actual contingent liabilities. The review relied on foreseeability, so effectively it was down to the salesperson on the day to foresee damage to you. but this ignores all of the damage done by this undeclared credit. Now, because of the way this review was set up, there was expected to be circa 30 billion paid out. Even Martin Wheatley said he couldn't, back in 14, didn't know if it might exceed the 17 billion paid out at that time on PPI. And yet what was paid out? Only 3 billion. Did the FCA mislead swap victims? Well, I entered into a debate with a technical expert at the FCA in 2016, where I alleged that the contingent liabilities and the rules around these were being ignored in the review. I got this email back, there's an excerpt here on 3rd of June 16, from David D'Souza, who was an FCA swap expert, saying, the IRHP review does of course consider whether the bank sufficiently explained to the customer the risks of potential future contingent liabilities. So on that same GP case I spoke to you about earlier, I managed to get hold of the internal Project Rosetta files. So these are the files produced by KPMG, acting in the review as independent skilled persons, in theory reviewing RBS's sales products. And what they agreed on that case was there was no evidence that contingent liability was ever discussed with those clients. So in theory, that should be full redress. Well, no, because what they go on to say is the reviewer confirms the setting and monitoring of the contingent liability is not, however, covered in the IRHP review. And then there's another line saying that in relation to contingent liability, the process is not related to the sales standard agreed with the FCA. So who's telling me the truth, Mr. D'Souza or KPMG in their internal files? On that case, despite 5 million of losses, no redress was ever awarded to those swap victims. But what I did following getting this information, I raised a formal complaint over my concerns here. I said that the review had substantial failings and not complied with the rules. And I alleged I was concerned I'd been misled by Mr. D'Souza in December 19. I raised this complaint. I'm still awaiting the full response 16 months later. Mr. D'Souza himself can't respond in person. He doesn't work for the FCA anymore. Mr. D'Souza, as some of you now know, is now Manager of Corporate Governance and Regulatory Affairs at the NatWest Group. And his key role is to manage and support risk and finance of the group along with the FCA. I won't comment further on that. I'll allow you to make your own minds up about that issue. So, is it fraud, as I've suggested? Well, I would suggest you consider NFIB 18, which is a specific fraud offence relating to the Fraud Act, Section 3, which says that this fraud is somebody who dishonestly fails to disclose to another person information which he is under a legal duty to disclose, and intends by failing to disclose the information to make a gain for himself or another, or to cause loss to another, or expose another to a risk of loss. So with that in mind, some quotes from an RBS whistleblower I've done a lot of work with in recent years, who told me, and also told Sir Norman Lamb in a meeting we did together with him, that RBS bonuses earned by selling swaps were so large that a commercial manager could double their earnings or more in a year. So the bonus rate was capped at 110% of basic salary. A commercial manager on £60,000 per annum could increase that to circa £132,000 per annum from just 2 or 3 good swap sales. In relation to the credit lines, the margin credit, the credit risk, he said, we were told not to mention the credit line risk to customers or even disclose that was the cause for sending them to GRG or into administration. When I pushed him to speak further to Sir Norman Lamb, I said, what would you do if it was the credit line that pushed them into GRG? And he said, Steve, on almost every occasion it was the swap credit line. We would find another way. We'd get a down valuation done. We'd pull another clause in the loan contract. We'd find another way to get a breach, but we wouldn't mention this to them on nearly all occasions. Well, I hope some of that was of interest to you. I think it's a very serious issue that needs exposing further. I've got substantial evidence on the issues that I've raised today. I don't just simply throw these allegations out without being able to back them up. I hope it's been informative, and as I say, if there's any questions on it, please do come back to me. And thanks again, Andy, and I'll pass it back to you.
Steve, that was absolutely first class. That really, really was absolutely first class. Obviously, ladies and gentlemen, before we do anything else, let's show our appreciation to Steve, because that would have taken a significant amount of time to prepare and deliver. That was absolutely first class. Well done, sir. Very, very, very well done. And I know that that is just the tip of the iceberg of the evidence that you and your colleagues have been amassing over many, many years. Steve, I'm going to jump straight in. I'm being a bit greedy. I'm going to go straight in with a question here. Ian Tyler made a point in the chat about the way that once the sale, so to speak, had been done, it would quite likely automatically hit the bonus pool straight away. So the whole business would have been booked straight away. How there's that Charlie Munger quotation, which I'm very fond of, which is, "Show me the incentives and I'll show you the outcome."
Yeah.
In your personal opinion, how significant is it that people were frankly incentivized to sell this stuff, and how much of the problem do you think could actually been explained away in terms of, you know, behavioral dynamics and all that kind of stuff, organizational cultural things? How much of this could be explained by the idea that the incentives to make these sales was off the scale high? What are your thoughts around that, please, Steve? And then we'll go to others with their comments and questions. Thank you.
I think the incentives are huge on this, Andy, because, you know, bank managers are intelligent people. You know, I've worked with a lot over the years, and most of them are very switched on, that they have a good understanding of finance. And I remember one of the whistleblowers I worked with, when he put the credit lines in place, he sent people to GRG. We were discussing it all, and I talked to him about the leverage, the margin credit, the risk. And I just remember him going whiter and whiter as we sat there. We sat having a beer in Canary Wharf, actually. And he almost couldn't speak by the time I'd finished, because he'd just been indoctrinated that this was quite a normal thing to do. He'd not gone through the whole process and seen where it really left the people. They were allowed themselves to be convinced that maybe rates would go up and maybe it would be beneficial to people. You know, but this level of incentive is unheard of, you know. I used to work as an investment advisor years ago. Then you couldn't earn commissions like this on single investment products.
Yeah. And is it? I'm getting this terrible sense of deja vu. I mean, I joined the financial services sector on August the 18th, 1986, as a financial advisor, etc., etc., etc. And I'm absolutely sure something like, I don't know, 10, 15, 20 years ago, the regulators, the authorities kind of cottoned on to the idea that if you have a sales culture where people are incentivized to make sales, you know, get to the top of the league table compared to their peers and all the rest of it, that was just like a toxic environment that was almost definitely going to cause chaos. So wasn't all this stuff supposed to have been rooted out years and years ago?
Well, the whole point of the rules that came in 07, MiFID, which are European rules, Markets in Financial Instrument Directives, really the whole crux of those rules were to stop these things being sold to retail clients. You know, previously, you know, private clients prior to 2007, where companies sort of turnovers up to circa 5 million, you know, audit level, and the new rules came in 07, and they made retail clients up to 40 million euro turnover, 20 million euro balance sheet, and the whole point was to give that much higher level of protection against these very sales. And yeah, I can tell you, when you study the rules, the FCA have built loopholes in the rules throughout, where the banks can just tick certain boxes and suggest that what they've done here is acceptable. You know, it doesn't stack up when you analyse it in the round, but when you do it in bite-sized chunks, which is what they do through these reviews, you can create tick lists that make it look logical. But no, you're right. It is the financial services industry continues to eat the consumer industry unabated.
Thank you very much indeed, Steve. Let's go to Andy Aitkenhead, then we're going to go to Paul Carlier. If I can, please invite everybody making comments or asking questions, please be as succinct as you can, and also if we can have nice and short and sweet answers as well. We're going to go Andy Aitkenhead, Paul Carlier, then Mark Bishop. Andy Aitkenhead, over to you. Thank you.
I think the points that I just want to make have been made in some form, actually. Ian Tyler, I think, made the point that in the chat that interest rate hedging products are indeed hedging products, you know, that and there is a value. And I think Steve just made the point actually as to why they were problematic, and it's actually around who they were sold to and the information. And I would say that my experience, I've actually traded just about every interest rate derivative going, so it's not, you know, but professional to professional, not to retail.
I completely agree with you on that. What I was obviously focusing on here is this retail market with these people never have been trading them. The OTC market, where these things can work as hedges, are where you're dealing with professional counterparties, eligible counterparties, professional investors. The first thing that happened when I got involved. Sorry.
Yeah, Steve. Yeah, so Steve, I'm not disagreeing with you at all. I think there are some points that you need to refine in what you've got. So contingent liability, from a bank's perspective, is indeed contingent liability, but it is this issue not just of the client being a retail client not understanding. Some of the people who were selling didn't understand what they were selling, and I don't mean just the bank managers, but people like RBS were putting people out there with limited information, who actually, you know, had very little grounding in terms of what they were doing. So it was almost a spiel. So it's, you know, it is a classic mis-selling exercise.
I think the point.
I think that you're. Go on, Steve.
Sorry, Andy. I think the point I was trying to get over, and obviously I know it's contingent liability. I know that's the correct wording for it. But I had a debate with a lawyer and a barrister a few weeks ago on this. What they were saying to me is that the credit line is not hardcore. It only crystallises when you break the deal. And what I was trying to explain is it's the other way around. The way certainly RBS accounted for these, the credit line was hardcore. If you broke the deal, you may get out for a lower level through a break cost.
Yeah.
That's how they accounted for it at RBS.
Yeah, no, I understand that. Just one other point, I would like to make this point clear. You know, banks do not control the direction of interest rates, however much people think about that. You know, it is a myth. Banks get it wrong just like everybody else. You know, there are people who lose money in banks just like the people who make money. People can make economic judgments, but people get it wrong. Now, you know, I think classically in this kind of case, we're talking about the issue between people who are professionals and people who are not. And that's the challenge, and the suitability of the products for use, which clearly they weren't in lots of cases. And I've seen it in, you know, going back 30 years, I've seen sort of corporate treasuries who are essentially professionals being sold products by banks that were not suited to their needs and not understanding it. So it's not just about the non-experienced retail. Some supposedly experienced people have been missold stuff very badly as well. You know,
Thank you, Andy. Thank you, Steve. That was a very constructive exchange of ideas. Let's now go to Paul Carlier, then we're going to go to Mark Bishop. And again, let's keep an eye on the clock as well. So please be as succinct as you can, folks. Thank you very much. Thank you.
Yeah, I just wanted to make a point. I mean, you know, 30 years in banks, the intent is always to make financial gain. You know, whether that's by hook or by crook at times. But there was a case before Christmas that was pleaded on the basis of commission, that the treasury salesperson was incentivized to sell the toxic product because he got a greater commission. Now, in the branches, there was a commission filtered down, but the treasury salesperson was never paid as a commission. In your contract, and I've obviously worked in treasury as a trader for many years, it was always that you were eligible for an annual bonus.
Right.
For salespeople, the hard markups would be assigned to them, and that would be accumulated over the year, and that would be one of the performance metrics that determined their annual bonus. Now, the case before Christmas was lost because it'd been pleaded that the treasury salesperson had commission, was incentivized, but RBS was able to say, he didn't get a bigger commission on whatever product he sold, and they were able to answer honestly because it wasn't technically commission. So they. I know, Paul,
I've come up against that argument myself legally, and I know exactly what you're saying, and you're right. Obviously, I've tried to keep it simple for the presentation by talking about bonuses. No, I totally. It was always like against target. So, for instance, at RBS, they ran a system called Compass. And what would happen, a credit would drop in from global banking and markets towards their annual target. And then obviously that would mix with all the rest of the sales that they've done. But the hard facts are, as I say, this chap said to me, I was quite shocked when he told me, Steve, it was that easy to make money on it. They had to cap the bonuses. Yeah. You know, and I was quite shocked by that.
It was. I mean, one thing that I actually left, got uncomfortable with the industry in 2000, and was that salespeople previously had the targets were always production credit or all in volume, and then they started to get given hard markup targets. Well, for a salesperson to take hard markup, they have to take the trader's best execution price, which the customer's entitled to, and then add something to it, which, you know, that's only going to end one way. That's only going to that's a problem from the start, and that became much more prevalent towards the end of the 90s and into the into the noughties, and naughty it became. So
well, I think we all say things quite slightly different. Like Andy, I get what, and I agree with what Andy said. Andy's coming from a banking perspective, you're coming from a trading perspective. My background's in investment sales, and where I try and liken this to people is I remember when I worked at Barclays, and this is going back 20 years ago. I worked with a premier manager who was dealing with all the high net worth clients, and he liked to get his bonuses, and he'd gone round and told all of his clients that they should increase their mortgages, by 100, 150, 200,000 pounds, and I would then put it into our managed portfolio, which was doing 10% plus per annum, and that way they would make a small fortune rather than what they're paying on the mortgage debt, and of course there would be double sales for him. And I remember speaking to compliance at the time and saying, I'm really, really uncomfortable with this. And of course they said, well, to be honest, Steve, we'd probably like you to go to prison if you do that, because encouraging people to borrow money to invest when it's secured against their own home is an absolute no-no, and probably the highest risk thing you can do. And this is how I saw it with these swaps. The fact that you're actually selling an investment, which you are, it is an investment, but lending the money without, if the customer knew about the margin credit, if they negotiated it, if they knew about the risks, all well and good. But they didn't have a clue, hardly any of them.
Thank you very much indeed, Paul and Steve. Let's go to Mark Bishop, then we're going to go hear from Mark Wright. And by the way, Mark Wright, as well as saying whatever point you want to make, can you please just give everybody an outline of your case, and please help everybody understand why they need to read your webpage, your crowdfunding webpage. Whether they fund or not is entirely up to them. Whether they make a donation or not is entirely up to them. But I want absolutely, literally, everybody on the Zoom session to read the narrative on the webpage that Mark Wright's going to make reference to in a moment. But first of all, we'll go to Mark Bishop and then we'll go to Mark Wright. Thank you.
Okay, thanks, Andy. I just want to ask a very quick question of Steve. So what interactions, if any, have you had with John Swift QC in his review of the redress scheme? And based on that and what other people have said who have had interactions with him, do you think it's going to be a whitewash? Do you think it's going to be helpful? What do you think will be the strategy to get redress for the victims once it's published? We know that it's been written and that it's with the FCA from actualisation. We also know it's not going to come out until late summer, and they'll probably drag it on a bit beyond that.
Obviously, I am, I think Paul and I have probably debated this a little bit before, and I'm probably a little bit more sceptical about this because ultimately I've seen so many sham reviews. I think Dame Gloucester gave us all a real glimpse of her with what she did. And when I read through the fact that she was told it was a lessons learned review, but she didn't agree and she was going to do it her own way, I thought big hurrah for her. And I just hope that he takes a similar position, because there is a huge issue over in Ireland at the moment, which some of them, you may know of this case, Chris Gordon, where he's got the Andrew Bailey and the FCA in as defendants. But there are, I believe, hundreds of people who should have been in the review who were held out of it. And I reported all this to the FCA, and they told me to go to the Swift team with it. So I went to the Swift team with it. I said, look, I'm concerned here because there are literally hundreds of people who maybe have lost, millions and were wrongly, incorrectly kept out of the review. But what could you do about it? My understanding is you're only lessons learned. And they came back and confirmed they could do nothing. The lessons learned, and they have no powers, and they can't do anything about it. So all I can hope is, I think I've got something like a 70-page transcript with the Swift team. I went down, met with them. I've given them case files. The GP case I mentioned here with that 3.5 million credit line, they've got that. They've got the responses from the FCA. If they've got to come out and accept this margin credit issue, this hidden credit issue, and the breaches of the rules and the sales standards, if they don't, it'll be an absolute whitewash. But the feedback I have from people who know John Swift is that he's a very good guy and very honest, decent, transparent person. So I'm fingers crossed for the best, to be honest, Mark.
Thank you, Steve. Thank you, Mark. From Mark 1 to Mark 2. There's a joke there somewhere. Mr. Mark Wright, over to you.
Thanks, Andy. Thanks, Alexandra, and great event as always. And well done, Steve. That was superb. I just want to add something very quickly on the back of Steve's presentation. We have multiple whistleblowers that assist and work with Steve from RBS. And I just want to point out that, I used to get the Economist report from RBS in the role as a wealth manager when I was there. I only ever had economist reports saying that rates were going south. So the fact that people were, you know, being scaremongered into these products. But I also want to mention something else, and this is significant because a couple of our RBS whistleblowers have stated this, that there was a directive came down from senior management at RBS that all of the senior relationship managers had to trawl through their portfolios. And basically any SMEs with 500K worth of borrowing and above, to get them on a swap. And then when you suddenly see Steve's presentation there, then it will all suddenly make sense that why we have such a problem with IRHPs and the toxic way that they were sold and the horror stories that you hear. So I just wanted to add that in because obviously that is from staff themselves that were encouraged to sell these by the bucket load. Moving on to the crowdfunding, yeah, we've managed to get our judicial review in to the High Court. Steve put a lot of work into that, as did Mike Fitzgerald with regards to the barrister with the work that he's done. What we've actually managed to do on with this particular judicial review and with the evidence that we've collated over many years is we've basically had the Bank of England governor lie and change his story more times than we all change our socks. Every time that Steve has backed him into a corner or the complaints commissioner into a corner, the story has changed. What I basically did, I'd worked for NatWest and RBS for 25 years, enjoyed the role, but basically not the rights issue. After the bank succeeded in one of the largest rights issues in history, I think in the first quarter of 2008, the bank was hemorrhaging money, you know, immediately after that. And it was around September 08 when there were whispers that there were problems with RBS, that we always had to rely on either the RBS intranet for all our latest updates or Sky News, because there was nothing really coming out other than what we could use internally, which were messages from executives and what have you. So when they were concerned about there being a run pretty much like Northern Rock, on the 17th of September 08, a day or two after Lehman's went pop, one of the directors, Chris Sullivan, who is central to all of the GRG issues, posted onto the RBS group intranet, you know, there's a bit of turmoil, you know, but we just want to we want you to reassure all staff, customers and shareholders the group is very well capitalized. Well, at that time, the bank were already negotiating billions of covert loans from the Bank of England. So that is hardly well capitalized. If you'd have held £100,000 in shares from the time that this market abuse statement was present on the RBS intranet from the 17th of September 08 until the end of January 09, your £100,000 in RBS shares would then be worth circa 10 grand. That statement was removed from the RBS intranet and never to be seen again. I whistleblew that, and obviously that was not something that they wanted me to whistleblow about, so they tortured me for it, and then I had no alternative but to leave. I went off sick in 2012 and then retired on ill health in 2013. Meeting up with Steve, he took me under his wing and basically started unpicking everything. And we have, when I was going to Sir Norman Lamb as my MP stating this is what the bank have done, Sir Norman was writing to the FCA, and I was stating about this market abuse. Very, very quickly, Karina McTeague, Director of Supervision, wrote back to Sir Norman Lamb and stated that RBS have done an investigation. They couldn't find anything to do with the statement, and we have no reason to disbelieve them. And that was the stance that the bank took. I put a complaint in, well, Steve put a complaint in at the FCA, and again with the complaints commissioner, and he won that complaint because as I was relaying stuff directly to the executive office at the FCA were getting straight on the back phone and going straight to RBS executive office saying, we've got Mark Wright here, he's one of you, blah, 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 and so on. it was only a few years later in 17 when I'd already done a data subject access request on the FCA, and that's, you know, there was nothing to be seen. I'd raised a complaint with the Complaints Commissioner, and I'd done a DSAR on the Complaints Commissioner. And in that DSAR, there were some emails in there that had been withheld from the FCA's DSAR. And we actually came across 2 or 3 emails which basically stated, we have found the intranet statement that Mr. Wright refers to. It backs up all of his allegations, and it would tend to give the impression to all staff that everything was fine. Now, we've then basically had some toing and froing backwards and forwards where Steve has backed the FCA into a corner. They then changed their story. The Complaints Commissioner stated that he's only seen part of the intranet statement. Steve asked, can we see that part? He said, well, I don't know if I got all of it or some of it. Steve said, well, get me the bit that you have got. Andrew Bailey will insist that the statement was authored by Chris Sullivan, Fred Goodwin, but everybody else at the FCA and the Complaints Commissioner say there's no author. So this has been a very long-standing cover-up, and like I say, when Group Counsel Will Luca came to see Sir Norman Lamb at Portcullis, Steve was banned from the room. He wasn't allowed to be in there. So Norman had the head of RBS Group Counsel in front of him. The RBS Group Counsel would not let Norman see the market abuse statement. He would read bits out. He didn't let Norman make notes. And basically, I think Steve put to them, and so Norman said, well, look, if the statement was okay to read out to hundreds of thousands of your customers in 08, why can't it be read out now? And the Group Counsel basically said it would be far too damaging reputationally if it was released now. So what the judicial review is basically, this is a public interest matter. We want to get this statement in the public domain. The FCA have basically tried to time me out on complaints, even though they've never responded to a complaint. So that's one of the challenges that Steve has put in. So for all of you that have already supported, I thank you sincerely, and I really do appreciate it. And like I say, if you can just get the cut and paste the link and just send it to all of your email contacts, that would be great, so we can spread this. Because if we can take a dent out of the FCA and the Complaints Commissioner that covering up and lying has to stop, then I think it will help us all going forward. So thanks again, Andy, and thanks again, Steve.
Wonderful, absolutely wonderful. Thank you very much. Can we please thank not just Mark Wright, but also the input we've had from Mark Bishop, from Paul Carlier, from Andy Aikenhead, and of course from Steve Middleton for that really clear, granular, compelling expose provided. Thank you very much indeed, gentlemen. It's been absolutely first class, absolutely first class. So those of you who attended the Paul Carlier session a couple of weeks ago, which was frankly equally epic, you know that I made a decision partway through it that I thought that in as a British citizen, I genuinely felt that it was my duty to make sure the Prime Minister got to know about what was revealed. I'm going to do the same again. I'm going to do the same again. The video recording of this is going to go to the Prime Minister, because if I was the Prime Minister, I would want to know what's been going on. This country needs a transparent, truthful and trustworthy financial services sector. We desperately need that. UK does financial services brilliantly, but it has to be transparent, truthful and trustworthy. And we can't have a financial services sector that is so exposed to this kind of stuff. You know, it's just intolerable. We have to have a regulatory framework that's fit for purpose. We have to have major executives of big, systemically important institutions like the banks behaving as they should. This is a massive, massive, massive public interest issue, and that's why everybody, please make sure you read that crowdfunding page and make sure you do all you possibly can to circulate it far and wide. That's the way we're going to win this, by making the truth get out there to as many people as possible. And thank goodness for social media, because through it we have the potential to do what would otherwise have been pretty much impossible. Thank you, Steve, and thank you everybody else that's participated so fully now. We're going to go to Paul Carlier, who's going to spend a little while just giving us some key points. We're then going to go to Dave Glynn, and then we're going to go to Hester and Marta. Paul, if I can ask you please to be as succinct as you possibly can be. Thank you, Paul.
I will try and be. Right, what you'll find is that the slides might be a little text heavy, but that's by design for people that want to download the deck afterwards and who might want to watch the video back. So just bear with me while I share the screen. Okay, so, right, I want to make it clear that I had to do this last time as well, that I don't like to waste anybody's time. I don't like to have my time wasted. So I never make an allegation or complaint unless I believe I'm right. Never make an allegation or complaint unless I've got the evidence to demonstrate it or prove it. And if I'm going to express an opinion, I will make that clear throughout the presentation. So, right, there's just a little bit of background. I mean, Steve's done a great job, and Steve's on the technical points, absolutely fantastic. I mean, you know, got a hell of a lot of experience, done a hell of a lot of groundwork in this. And I'm going to basically try and use one case that I've got as a sort of start to finish, end to end demonstration of what Steve's been describing, what I'm going to be describing, and the real, just to show the real impact and how what starts out as just the sale of a collar or a swap then just becomes something far more toxic and nuclear and absolutely catastrophic. So like Steve's already touched upon, you got marginal lending was being squeezed massively as everyone was rushing to lend. So the banks were under pressure to make, how do you make more revenue out of lending? And swaps was the answer. Initially, the straightforward caps, but you know, quite quickly evolving into something much more. So, but one thing that I've always, always found that I can't believe isn't used more often, and that is that by definition, a hedge is reduction or removal of risk. And to put it in its simplest terms, car insurance is probably the best way to describe it. We've all got car insurance. So when you buy car insurance, you pay a one-off fixed cost. That's your total risk. It doesn't matter what happens. You could total your car, 20 grand, whatever. Your total risk is that one-off cost. And there are no circumstances where your insurance company says to you, how would you fancy offsetting some of that cost by selling us insurance on somebody else's car? But it's never going to happen. Nobody's going to do it, because then your risk becomes a real problem. You don't know what your risk is. You might be paid £400 for that, but you could end up having to cough up 20,000. So there's an unknown, and that's where the whole issue of contingent liability comes in. So I'm an FX trader, 28 years, and we have a product in FX which is the equivalent of a collar, and it's called a risk reversal. And the clue's in the name. The product reverses the risk, replaces one risk with another. So a collar was never an actual hedge. A collar was never an appropriate product, because it it introduced a completely new risk that didn't exist before. And I can say this, as a former Lloyd's director and a senior FX trader, you know, me and my team, with all of our combined years of experience, were only permitted to buy derivatives that were the equivalent of caps. We were prohibited from selling any derivative full stop or buying any derivative such as a risk reversal that incurred any risk. Now consider that they're prohibiting experienced traders from doing that, but they will gladly sell the same products to SMEs with no experience. So buying a collar literally made no sense when you consider what the alternatives were. You've got caps, fixed cost, that will hedge your risk. That's an appropriate product. You've got a risk that interest rates might go up. You buy a cap, you know that you're covered. If interest rates go above there, that's fine. You will not pay a penny more, and the only risk is your premium. But it makes perfect sense for the bank from a revenue generation perspective, because a cap is a simple product, whereas a collar contains two components, a cap and a floor. Okay, and just like when you buy a car, every component or feature you add, there's more profit or markup for the car firm, right? You want to put a sat nav in, they'll make a profit on that. You want to buy alloy wheels, there's a profit on that. And these products were no different. So they became more and more complex because there was more and more opportunity to make markup. But the real illusion here is that they could make the product actually seem cheaper to you, because obviously you are paying for a cap, which is insurance that you need, but you're selling insurance, and in other words, getting money back in. So they could offset that. So it looks on the face of it that you're actually making a bit of a saving, but in actual fact, the bank is probably almost doubling the markup it can make on that product. So, and obviously then you get into more structured products and with, kickouts and everything, and then you're talking, ridiculous sums. But the one thing they never ever told you about, and Steve's already touched upon it, initial margin requirement and variation margin requirement. I mean, Steve's gone into a lot of detail about this, and there's a reason. Like, anytime you want to buy a product where the customer is exposed to risk, there's a margin requirement. Now, this isn't fanciful, this isn't made up, this is an actual requirement. So to determine the monetary value of that requirement, a calculation takes place. We've seen it now. They'll calculate using a variety of metrics what the potential risk or contingent liability of that product is, and that calculates the risk to the customer or the counterparty risk of the bank, i.e. if you haven't got enough money to pay it. So the bank then seeks from the customer the required amount as security to cover this liability or potential liability. Now, this is an actual example. This is a trade ticket from the Saxo platform that I use. So basically, if I wanted to buy, which is the equivalent of a put in sterling versus a dollar, which is the equivalent to a floor, if you look down here, I don't know if you can you see my pointer?
We can't see your, yes, we can see your pointer. Yes.
Okay, so if I want to buy that product, you see here, it says initial margin impact, 0 sterling, because my risk is literally the premium that I'm going to pay for it, which is down here. There's no initial margin requirement at all. However, if I want to sell that product, I've got to stump up £10,000 in cash or on account that will sit there for the duration of that product, right? So, and that's an actual requirement. This is not a fanciful thing. It doesn't matter what you do. This is an actual requirement. Now, that presents a real problem for the bank if you're selling a collar or toxic high risk IRHP to a customer, because the bank's got to ask the customer to place an account with them the money for the initial margin requirement, but or the bank has to tell the customer to provide additional security to the bank to cover the value of the initial margin requirement. To do this would guarantee that no customer, sophisticated or otherwise, would ever buy the product. So the bank just doesn't tell them that this requirement exists, and it does exist. So the bank simply took out a credit line or facility in the name of the customer, or took a charge over a property or asset to the value of the margin requirement, and then concealed that from the customer. And disturbingly, I've learned from a sole trader recently that they didn't take out a hidden credit line. They just took a charge on his home without telling him. So there was enough equity in the house, we'll take a charge on that. Didn't tell him, just, and didn't find out 2 years later that it existed, and when they went to go after it. So they also don't tell you that there's variation margin, right? So initial margin is what you have to put up front, but they don't tell, if the interest rate moves against you, the risk increases, and so that the margin increases. So the bank would actually have to then make a margin call on you to stump up some more cash. Well, there's a problem there, because the bank hasn't told you about the existence of the credit line in the first place. So, okay, we just won't tell, we'll just increase it anyway. So they increase the credit line, or they increase the value of the security they've got. Now, I mentioned a case last time that I believe is the case, and it's the case of Angel Group and Angelic Interiors that were formerly owned by Julia Davey. Now, the purpose of this is to demonstrate how it began, how it evolved, and what the consequences were. And it's a case study, but it's a frightening one. So in 2007, Angelic Interiors, which was a company owned by Julia Davey, who banked with Lloyds, took out a 20 million credit facility. The relationship manager presumes that they would satisfy the hedging requirement by buying caps. They'd always bought caps in the past, so no, and he actually says, I presume you will buy some caps. He says the treasury person from Lloyds would be in touch. So they get an email, they get an email, and sure enough, the treasury guy is very helpful, prices up the cap, But see here, he mentions the 5-year fixed is 5.93%. Now, just remember that as we move forward. Okay, so you can fix it 5.93%. That's it. You haven't got to worry about a swap or a derivative. So he quotes there's 141,000 premium if you want to buy caps at 6.5%. But he's already quoting 5 years. The facility that has been hedged is 3.5 years, which is a big issue, which we'll come to. However, he then goes on and on a completely unsolicited basis to say, in order to reduce the cost, and introduces a collar. The customer never asked for one, never wanted one, and never shown any interest in one. But he introduces it entirely so as to reduce the cost. Now, the FCA register for this salesperson shows that at that time, it's CF21 investment advisor, right? So this guy knew his stuff. And that's the other issue here. Anyone that worked at a bank that was going to be selling these products had to pass exams, had to be trained. There is nothing they didn't know, okay, about these products. So the hidden credit lines, all this other stuff, understand that they knew all this was a requirement of these products. So did the bank provide any retail customer with any information about the collar? Well, sure, they got this. Okay, now look at this whole list of benefits here, whole list, but they don't put any downside to it. It's just 2 points to consider. Okay, a premium may be payable, and any amendment to the contract may result in a cost to the customer. There is literally no mention of risk, no mention of any other downside. That's it. And even if you look at this graph down the bottom here, look how big the benefit to the customer looks relative to the risk of, if it goes the other way. Everything about it is designed to make this appear very attractive. I mean, and that is shocking. And what you have to remember as well, we had a settlement meeting. We're sitting across the table from the lawyers, and they said, oh yes, but the customer asked some good questions, so they clearly had knowledge. But when you pointed out to them that the customer's questions were limited to what was in this document. So effectively, the customer's knowledge and understanding was limited to exactly what the bank had told them, nothing more. They didn't ask about the contingent liability, didn't ask about the credit lines, didn't know. So, but when the trade was eventually struck, this is the confirmation, okay? So it went from a 15 million collar to a 20 million collar, 100% hedging, and for 5 years to hedge a 3.5-year facility. And it was against LIBOR, not base rate. Obviously, the banks were manipulating LIBOR, so there's an advantage to doing a LIBOR-based product. But the premium, 132,000. So net, compared to the earlier product, it's a saving of about £9,000 in premium. Okay, so again, no mention of the margin requirement, no mention of the hard credit line taken out by the bank and name the customer. But did the salesperson in the bank know there was an initial margin and variation margin requirement before and at point of sale? Of course they did, right? This is, so let's be clear, they 100% did. Now, here, this is an extract from an internal note authored by an LBG credit analyst to the national head of the credit committee at Lloyd's. And in it, he confirms that they've taken out what is a 2.25 million hidden credit line to cover the 20 million collar for 5 years. Okay, now this was never disclosed. This was only obtained years after the event. So Angelic Interiors thinks it's taken out a 20 million credit loan. It's got a 22.25 million loan. Okay, whereas, and what is also really helpful here is that he says the first 20 million loan is covered by a 20 million cap facility, which incurs no FMD. FMD is financial market derivative line. Okay, so that's the hard credit line. So he says it incurs no liability. So again, confirming that there's this hidden credit line, and if they bought caps, no such liability. Now, on here, again, similar notes, again, obtained after the event. As you can see here, they're actually including the hidden credit line, which at the time was 2 million before it was increased to 22.5 or 22.25. And they're talking about 22 million as the actual L in LTV. So this is the loan is 22 million. That's how they're factoring it into the LTV. So I've got a real issue with this because they had a loan covenant where they were obliged to stay below 80%, okay, loan to value. Now, as Steve explained earlier, how does a customer possibly abide by that loan covenant that's in their loan agreement when the bank is concealing a component that makes up the L. So if the customer cannot possibly abide by that covenant because the bank is depriving them of information, does that not make the agreement void? I mean, that's a question I've never heard asked, or I've asked it plenty of times, and no lawyer or bank will answer the question. But surely it must, because you tell the customer you have to abide by that loan to value obligation, but they can't possibly. And then they'll quote, as Steve mentioned, they'll quote a technical default, but won't explain to the customer what the technical default consists of, i.e. it's your loan plus your hidden credit line that we haven't told you about. So and perhaps more importantly, and this is something that I know Mike Lloyd's on this tonight as well, that he'll be aware of his experience, but this is the these notes here show that the relationship manager Higby, he's trying to get fight for the credit rating of Angelic before they were sold the collar. And he says that because they are not exposed to hedging liability, he suggests that a facility rating of 1 is appropriate. So basically he's saying because they don't have a hedging liability, this customer deserves the highest possible credit rating. And therefore, if they have one of these, you are adversely impacted in your credit rating. Now, what that does, it downgrades the value, your credit profile within the bank. So in future, you're going to be subject to higher borrowing costs. But what it also means is that you tell any other bank that you have one of these products, they are going to run a mile. And, Mike Lloyd, is on here tonight. He had exactly the same. They were trying to desperately find an alternate arrangement and nobody would touch them because all the banks knew this. All the banks knew that these products carried these huge credit lines and they were an absolute liability. So, the banks would say, oh, you could have gone elsewhere. No, you couldn't. You were trapped. So that's a really important thing. So this is the situation. Angelic Interiors were sold a collar for 132 grand, whereas they were initially quoted 140 grand for the caps. Do you believe they would have bought the collar to make a modest saving if the bank had also said that which they were bound to say? Okay, then, in order to enjoy that modest saving, you need to give us 2.25 million cash to satisfy the initial margin requirements for this product, and that we will hold on account for the 5-year duration of that product, and that you cannot touch for that 5-year period. Oh, and just so you know, if interest rates fall, we'll have to ask you for even more cash by way of a margin call. No company in their right mind or any reasonable person is going to agree to that product for the sake of an 8 grand saving. I mean, just insane. But importantly, the banks also knew that no one's going to agree to that. That's why they concealed the existence of these margin requirements and the credit lines. And then, but they've still got to satisfy them, right? They've still got to satisfy that margin requirement. That's why they took out the hidden credit lines. And that's why they concealed them. So let's be clear here. This was an intent to make financial gain, and they did so, as Steve pointed out, by failing to disclose information. I would also argue that it's false representation and also fraud by abuse of position. You're in a position of trust. You're dealing with non-sophisticated customers. You are bound by integrity rules and COBs, and you've absolutely and abjectly abused it. And let's be clear as well. The guy said, "Okay, you can. This is to reduce costs." But even that is entirely false because the existence and the cost to service, the margin requirement, would have more than negated any saving in terms of premium costs, because you could have had that 2.25 million invested somewhere, right? Even if you had it on deposit, earning 1 or 2%, you'd have made more than the 8 grand that you'd have saved. It's just it's absolute fraud at point of sale. Right, so in March 2009, interest rates collapsed, and this is where you start to see the costs, the hard costs being accrued on that product. And what I should say as well, a year after that product, the swap was sold in 2008, the bank capped the drawdowns. So Angelic had only drawn down about 9 million, and the bank said, you can't draw down anymore. That was it. So they were only 9 million drawn on a 20 million facility and had a 20 million collar to effectively hedge 9 million of lending. Right. And now you can see here how rapidly, with interest rates collapsing, how rapidly their costs start to ratchet up. And that totals 1.5 million, okay, from March 2009 to September 2010. And that's hard cost. That's not like continuing. They had to pay that money every quarter. So this had significant additional consequences for Julia Davies' businesses as a result of the collar. It would drive Lloyds and HBOS to collude. Now, people think, oh yeah, the merger, that they were one the same. No, they weren't. right? When I joined Lloyds in 2012, they were still operating under 2 banking licenses. So everything had to be separated. So a Bank of Scotland customer that called up for a price in foreign exchange would have to speak to a Bank of Scotland salesperson who would contact the Lloyds Bank salesperson who would then ask me for a price. That's how it had to operate. So there was a distinct 2 banking license. They couldn't share any information with each other any more than they could share it with HSBC or Barclays. And yet they were concerned. So HBOS and Lloyds were talking. Obviously, they were concerned about the costs and the risks that Angelic were incurring on this swap. So they wanted to get HBOS to help them by getting them to agree to a cross guarantee, so that the Angel Group, which banked with HBOS, which had a ridiculous 53% loan to value, would cross guarantee the Angelic, so that it gave the bank even more comfort because of these huge costs. Julia refused, and the bank engineered what we now know to have been a fake default on her other business, Angel Group, in September 2009. And they did so they could force both businesses into BSU, whereby they believed they would inherit the rights to commingle the affairs and assets of the 2 businesses and obtain the security they wanted. That's a whole other story for another time, but this was an awful consequence. So let's jump forward to September 2010, when both businesses were in BSU. So this is what the businesses are paid. So we get to September 2010, and the facility only has another 3 months to run. The facility runs out in January 2011. However, the swap's got another 20 months to run. And the break cost, therefore, is 1.77 million to escape from that swap. Whereas if it had had the maturity date the same as the facility, 1 more quarter, another 240 grand, that's it. Okay, we pay that, we're out, and that's it. There's no, we'll never touch one of these things again. But obviously they're in a situation, they're in BSU, the bank's badgering it, they've got 1, but you can't escape it because you haven't got 1.7 million to fork out. But they should never have been in a position where they would have had to have done, because of the disparity in the maturity dates. So they were faced with either another 20 months, 1.7 million break costs, or 1.84 million in further costs. And it existed because of that mismatched maturity date. So what did the bank do? Did they offer a remedy? No, they leveraged the situation that Angelic found themselves in and sold them a 40 million new structured collar on the promise of a new facility, and as a means of them not having to pay the 1.7 million break costs of the existing collar. So they're saying, don't worry about it, we'll wrap, and this is one of the biggest cons in banking, we'll wrap the cost into another product. So basically you're rolling forward. It looks like, oh, we're getting away scot-free, but by doing that, you are just giving the bank the opportunity to make more money. And boy, did they on this case. Now, they said to them, buy this, and we've got credit approval, and then this will help get the new facility over the line. So they bought the product. And as you can see at the bottom of this screen here, it would go on to cost them 2.93 million in costs over the duration. Okay, but let's be clear, after they sold them the 40 million structured product, the bank would then claim there was no new facility. Okay, now that cannot be true, because if the credit department had approved the new 40 million IRHP, they must also have approved the new facility that this new IRHP was to hedge. There can't be one without the other. It's either all or nothing. So, and as you say, it would go on to cost 2.9 million. And that's hard cash. Again, it's not like it's a contingent thing. That's being paid out every month. So, and that's in addition, this is the kicker here, that the bank made 670,000 markup on the sale of that 40 million product. An absolute shocker. But what you have to remember here, that the contingent liability on that 40 million product was 4.6 million on its own, right? So the bank, so now the business has got 44 million in lending, thinking it's only got 40. But what you have to remember, that at the time they bought the 40 million IRHP, the first 20 million still had caps. That was all nicely hedged. And they'd only been able to draw down 9 million of the second 20 million. So the only amount of unhedged borrowing they had at the time was 9 million. Okay. And the hedging requirement was 75%. So they only actually needed a swap for 6.75 million. And the bank sold them one for 40 million. I mean, it's just absolutely staggering. And it really was a case of out the frying pan into the fire. And just for the record, and I've had this argument with a few other people, that the solution to problems caused for a customer by the sale of a toxic and high risk derivative can never be the sale of another one. I mean, it's just insane. How can that possibly be a solution to anything. So in summary, in 2007, the bank could, let's use what the IRHP review said. Okay, there has no collars weren't appropriate, no mismatch products in terms of maturity. So the only actual products that should have been available or appropriate were either a 3.5-year 20 million fixed rate facility, which we know was 5.93%, and obviously that's it, no costs, that's done, that's just locked in, or 3.5-year 15 million caps to maturity date, which would have, so basically under either scenario, the maximum total cost the business would have incurred was 140 grand. Okay, but let's just stop for a moment and say, okay, so the collar was inappropriate in every sense, but let's just say, okay, that the very worst the bank could have done, even selling an inappropriate product, was to have sold a 3.5-year collar for 15 million, whereas the bank sold them a 5-year collar with a 20 million notional. There is nothing about the sale of that product that isn't, in my opinion, fraud, and they knew what they were doing. And Craig's going to talk later, so I won't steal his thunder. Craig's going to talk about the later years in terms of the volatility and why that makes a big difference. So just to recap, Lloyd's made 83 grand markup on the sale of the first collar, the quarterly costs, it all adds up to a total cash flow cost to the business of 5.19 million. Okay, now when you consider that the Angel Group was forced into administration in October 2012 because they were just short of enough of 100 grand to pay the British gas bill, although we know that the bank had 950 grand of the business money still stashed in an internal wash account, you can see what difference that would have made. It is no exaggeration to say that Angel Group and Angelic Interiors would have thrived and survived but for the sale of that collar. And then but for that collar then triggered a whole sequence of other fraudulent events along the way that would end up with the destruction of the business. So this case is not an isolated case. It's one of thousands, and I mean thousands. Now, the actual consequential damages here for Angelic and what they had, they've got a prime site in Canary Wharf, known as the Triangle site, which we believe was actually the motivation. Destroy the business, we'll get our hands on that site, because the bank knew in 2006 that Triangle site, upon completion of development, and it's right on Canary Wharf, would yield a 90 million profit. So destroy the business, make it look like, we've lost money, then we get the asset and we make the money over here. So it's like we destroy the business with the right hand and we make the money over here with the left hand. I mean, there's a term called consequential damages, but we also need to introduce a term called consequential profit. So whilst the bank's making you believe, oh, we lost money over here, we can show that because of the actions they took to cause the losses for the customer over here, that had a consequential profit for them over here. And that's what they were doing. The right arm, the left arm, it was all a deception. And so this was fraud, thousands of them, but it was all conveniently and wrongly packaged by the FCA as mis-selling, and entirely so as to give the banks a liability shield. Now, some of you may have seen this before. This was in the New York Department of Financial Services press release, May 20th, 2015. And Barclays had to plead guilty to criminal charges over these sales practices, okay? And here we have the sales employee saying hard markup is key, but I was too early. You don't have clients, you don't make money, so don't be stupid, okay? So he would then go on to say, what the markup is making sure you make the right decision on price, which is what's the worst price I can put on this where the customer's decision to trade with me or give me future business doesn't change. If you ain't cheating, you ain't trying. Now, Barclays were fined $2.5 billion for these various practices, including that one. Other banks didn't get punished necessarily for that because they didn't have two salespeople stupid enough to actually write that on a chat. But let's be clear, every bank I ever worked for, that's exactly how every salesperson operates. It's no different for double glazing salesmen. You just make the worst possible price, and then if the customer comes back, it's, oh, sorry, I was looking at the wrong screen, or, oh, it just so happens to have moved your way. There was always a line that they could get away with improving the price without making it look like they were trying to fleece the customer in the first place. Fraud, end of story. So let me get back. I'm going to speed it up, Andy.
Okay, could you just spend like the next 3 minutes bringing your piece to a close? It's
sure.
Incredibly hard-hitting stuff. We know your content is once again like off the scale impactful. And of course, the slides are going to be circulated, and I'm sure you wouldn't mind people contacting you if they had any
Absolutely
particular specific questions.
I'll
Thank you
quickly
very
wrap
much.
it up then. So basically,
Perfect.
Angelic were told they were in the IRHP review. Then January 13, the new sophistication criteria is introduced and retrospectively applied, and they get a letter in June 2013 saying, because of that criteria, because your swaps now were valued at more than, or had a notional value of more than 10 million, you're now classified as sophisticated and you're excluded from the review. Had they been in the review, they'd have got the 5.1 million back. You know, that's without any consequential stuff. And obviously we know what sort of difference that would have made. So the whole thing with the review, 5,300 customers who were always classified as non-sophisticated were excluded from the review entirely for that reason. Okay, we estimate that saved them, the banks, about 15 billion in damages, because obviously, like, you know, these were the 5,000 biggest customers. So according to the Treasury and the FCA, the reason for the introduction of this new criteria was that they wanted to exclude subsidiaries of large sophisticated customers, or SPVs formed of large sophisticated customers. Okay, so I'm going to whiz through. There's more of this. I've got a whole thing online about this, but this couldn't be true because it made no sense, and you'll see in my findings. But the whole if they claimed that they found these in the pilot study on a case-by-case basis, and that's why they introduced it. Well, if you found these customers in that case-by-case basis study, in the pilot study, you'd find them on a case-by-case basis in the review. There was no need to bring in this solution. So I emailed somebody who was heavily involved with the FCA and the IRHP review and said, I had a question about this criteria. I said, as I understand it, the banks colluded, for want of a better word, after undertaking some reviews, and went to the FCA as a group to have the limit introduced. This person unequivocally said it was put in by Sajid Javid on behalf of HM Treasury to reduce the impact and cost of the IRHP review scheme. They personally tried to fight that, and then he also confirmed that the FCA told me that HMT, Her Majesty's Treasury, intervened and attended meetings and forced this criteria through. So James Hurley wrote a good piece in 2019 on this, and there was calls for questions. Those questions have never been answered, and I've got all the evidence. So I reported my allegations to John Swift QC and his team, and I met with him and his team. I walked them through all of the evidence I had to show that Javid was involved, the witness testimony I had from 2 different sources, the other evidence I had as well. And they asked me all the right questions, which was encouraging. But there was no doubt in my mind that they didn't understand the significance of this and that he was implicated. That was February the 12th, 2020. Sajid Javid resigned as Chancellor the next day. Make of that what you will. Okay, so there's a whole piece. Sophistication is the key, but I've put a link in the chat. There's a whole piece I've done on that. Sophistication is nonsense. Okay, the real sophistication measure that the banks use is how much does the customer know about the product and how much does the customer know about the true market price of this product. It's all with intent to fleece. It's got nothing to do with, how appropriate can I be with this customer. So, and just these are the last 3 pages. This is from a document called Project Gresham, and this expands on Steve's point earlier about the review and what the scope was. Okay, this was given to the skilled persons running the review. Okay, now I'll whiz through them quite quickly, but it gives out all the reviewer role and the responsibilities. Okay, and as you can see there, no mention of hidden credit lines. On here, all the different sales process, no mention of hidden credit lines. Okay, and all in here, no mention of the hidden credit lines, none. They were essentially excluded from the review. So, how can the FCA knew that these things were, these things were rotten to the core, and that the concealed credit lines were the instruments that did most of the damage. And yet the FCA had them excluded from the review. And so, it's basically the biggest, as Steve said, is it the biggest fraud in banking history? I think when you add up what the losses and liabilities were, and the businesses were deprived of over 15 billion in damages by way of this scheme, I think we can safely say it was. So,
Mr. Paul Cardier, thank you very much. You've well, I'm stuck for words. You've done it again. Really, really impactful evidence, backed up with clear, compelling proof what other word can we use? We're going to go to our next speaker shortly, but of course, before we do that, can we please put our hands together for Mr. Paul Carlier and for sharing that very, very hard-hitting evidence. This is exactly what we need, folks. We need to get the truth out there. We need to show the evidence. We need to ask the questions and relentlessly keep asking until the answers eventually come. Paul Carlier, once again, we salute you. We're now going to go straight to our next speaker. So we're going to go to Dave Glynn. After Dave, we're going to Hester and Marcia. And then we've got our jams. Jam is just the minute round. Peter, Craig, Clive, and Andy Verity. So can we please hear from Mr. Dave Glynn? Thank you very much indeed. Thank you.
Yeah, I've spent 45 years in international investment banking. A number of those years in Citigroup when interest rate swaps were first on the horizon, and when they were, if you like, real swaps where people had entered on the one hand into a variable rate loan, and on somebody else had entered into a fixed rate loan, and they decided that really they wanted to one preferred the facility that the other one had. And what it was really driven more by the fact that there was interest rate arbitrage between the US and the UK, so you could borrow more cheaply in one and lend in the other, and these sorts of things. And it evolved into what it is now over a period of 30 or 40 years. But in the beginning, they were terribly simple, really add-ons to an interest rate, an exchange rate swap. What I want to do here is really take a look at the way swaps are valued and the importance of those values to the banks in reinforcing balance sheets that were effectively decimated. And of course, M2M, mark-to-market accounting, was very much the tool that enabled this. So if we go to the next swap now, Alexandra.
The next slide, yeah.
Yeah, sorry, it sometimes takes a while for it to move.
Thank you.
There we go.
Right, here we have a swap on day one. If we just look at what we have is a swap with a notional value of £2 million, a fixed rate of 5.75%. It's a 15-year swap with 5-year breaks. Remind me later if we have time to look at that funny number 5.35% and that other funny number 1.6 million. But on day one, on the 29th of November 2007, which was the strike date of this swap, of course, the swap had no value because the fixed rate and the variable rate were one and the same thing. And what we do in terms of calculating the mark-to-market value, it's the net present value of the projected flows of that swap over its life at the current rate. So the current rate was 5.75. The spread was zero, so of course the net present value is zero. But very soon, if you go to the next slide, Alexander, please. A week, 10 days later, the Bank of England dropped base rate from 5.75 to 5.5. This brought about minus spread of £415 a month. And if we again project it over the remaining life of the swap, the net present value, i.e. the mark-to-market value of that swap, was £18,000. It's not anything that the finance director of RBS is going to get out of bed for to record that kind of markup on an individual swap. Things change a wee bit if we go to the next slide. Now it gets interesting. There we are at the key date, following the Bank of England Monetary Policy Commission committee meeting in November 2008, when base dropped to 3%. Suddenly the spreads were a wee bit more interesting. There we are. £4,280 a month on a £2 million swap. The net present value of that swap, or the mark-to-market value of that swap, was £166,000. That is a liability, amongst other things, that the bank will add to your loan liability. So your loan liability increases as the bank's profitability increases. If we go to the next slide, now we look in March 2009, again, the Bank of England dropped base rate to 0.5%. Now, when you see values of 0.5%, you would think that people were queuing up at the doors to deposit money with the bank, that people were fighting till there wasn't a penny available. They were absolutely broke. They had not a penny. And instead of base rate rising, as one would expect, in the face of infinite demand, and zero supply, prices tend not to fall. But here the Bank of England decided that they would. And of course, there's one reason. There are thousands and thousands of these swaps. Let's say there were 16,000 in RBS alone in SME swaps, probably worth about 5 billion in terms of mark-to-market markups. It's quite incredible, quite incredible. And if it wasn't for, and if we go back to the previous year, to the December 2008 markup, if it wasn't for the reduction in benchmark rates there and the improvement in mark-to-market values of the books, RBS, Barclays, and certainly Lloyds would have failed the year-end solvency tests. It was the markup of the derivative books and the other fixed asset portfolios that saw them through that financial year-end. Now, all the time, these values are accruing against the clients. That 276,000 is a real number that the person holding that particular swap was faced with as a markup on his borrowings. And that markup on the borrowings, when looked at a few months later, was one of the reasons given for a transfer to GRG, i.e. that exceeded the loan-to-value ratios, albeit that these matters, as both Paul and Steve simply said, were undisclosed, totally undisclosed and unknown. Now, if we just go to the next slide. What we were told is that we were being protected against interest rate increases. Now, supposing interest rate increases in November 2008 had gone to where the premium on the RBS prefs were, i.e. 12.5%. Here we have a swap where this particular client would have been in the money to the extent of about £400,000. And do you think RBS would have paid that? If we go to the next slide, let's have a look at the accounting considerations of these things. When a swap of this nature, you have two options in terms of accounting. Either you can say, look, well, I'm sufficiently well off, I don't really need any markup, so I'll take the money over the life of the swap, in this case over the 5 years, and I'll accumulate 326,000 and some pounds. Or I can do the other thing. I can say, well, all I'll do is I'll record the mark-to-market value of it now. And that does wonderful things because I've taken 5 years' income virtually all at once. And I'm quite happy just to record the residual income as it comes in. So what's happened here is that mark-to-market gives the bank the opportunity to record the income it would otherwise receive if it sold that asset to a third party, and it retains the rights to the residual value. One of the problems, one of the big conflicts, I think, with mark-to-market accounting of this nature is that here, in a very significant part of the bank's business, we have products that rely on interest rates falling. And yet we're going around telling people that they must buy these swaps because interest rates are going up. And in our corporate strategy, as a bank requires that they fall. So in effect, we have a complete conflict between the bank's financial strategy and its marketing strategy. And when this is all aided and abetted by a level of LIBOR manipulation, which we encountered previously, which saw rates reduced over a 14-15 month period to 1/10 of their value, we have the answer, if you like, where mark-to-market accounting allied to LIBOR manipulation was the solution that allowed, if you like, the Treasury not to be required to put in more than 65 billion into RBS, because in effect, the poor SMEs who had taken on these swaps were doing it for them by way of the spreads on the swaps and the mark-to-market value of those spreads. Now, if we just go to the, and I'll finish off briefly here because we haven't had the time that we require, go to the last slide. And all of this, and Steve mentioned earlier, the clog on the equitable right of redemption. All of this has been unlawful since 1762, when Lord Henley made his famous ruling that said that you can't, at the same time as you enter into a loan agreement, enter into a separate agreement that prevents the borrower from redeeming his security on satisfaction of the debt. And this is exactly what these swaps do. So I'll leave you with those thoughts now and pass on to the next speaker.
Mr. Dave Glynn, it's the first time we've had you speaking, and I'm very, very impressed and very, very, very grateful to you. Can we please show us appreciation to Dave Glynn? That's been like a masterclass on the accounting treatment of all these issues. You've really taught me a great deal, and I'm sure others have learned from you as well this evening. We're going to be going straight on to our next speaker. So the structure tonight is we're going to work our way through our speakers, and then we're going to have a Q&A discussion, etc. at the end of that. So we're going to go now to, I'm trying to get the pronunciation right, to Hester and to Mattia. So please, let's show our appreciation to them, and off we go. Thank you very much indeed. Super stuff. And I'm going to click on to speak of you. Hester and Mattia, please do share your thoughts, please. Thank you very much. Thank you.
Yes, thank you. Good evening, everybody. I hope you still have the energy to listen to us. Sure. Unfortunately, my colleague Maartje has to leave. She had an appointment, and we thought it would end it a little bit earlier, but okay. Well, I prepared it, so that will not be a problem. But apologies for leaving. Well, it's difficult not to repeat the whole story. Oh, I was just making coffee. Sorry, now you're here. I thought I had some time for it. Yeah, well, Maartje and I are partners in the law firm Bites Legal. We are both attorneys, and my background is a lawyer in the financial industry. I worked with ING, with the Dutch exchange, LCH ClearNet, Euroclear. And in 2007, I switched to the bar to become an attorney. So I have a background in the professional environments, in the wholesale markets, and as a firm we advise professional financial undertakings. I always say the interest rate swap. Well, we call it gate already in the Netherlands, renteswap gate. It's a Dutch word. It's my I don't know the English translation, but it's a hobby which became too big. And to give an answer on the question, is this the biggest banking frauds? I'm writing a book, and I hope to publish it in the summer, and it's called Worst Bank Scenario. You can find it on bankenfraude.nl. It's in Dutch, but I hope to translate it in English too. And well, I'm now convinced that it's a European fraud and also network corruption. And I also think it's related to the low interest rates by the European Central Bank. In relation to the split or the sale of the insurance companies or the model, but I will explain that. I first will react on the former speakers because I don't want to tell the same story. So I think I endorse all the findings, and I can also say that as an attorney, can only tell things on the basis of evidence. So, which means that we also have all the evidence that you saw in the UK files. I have account statements, contracts, amended contracts. In the Netherlands, we had a requirement in the contracts as from 2006 in the loan agreements that they had to hedge the interest rate risk. So they were forced into swaps. It's also that, well, I think I can confirm as lawyer that it's a violation of the duty of care under MiFID. And this is a very broad, it's a lot of rules like the client due diligence, etc. But also, and I think that's the difference with the UK. In the Netherlands, we have legal requirements in respect of the margin requirements. So for non-professional investors. And I think that's also the reason that we can prove it more easily, because we have also contracts in regard of this margin requirements. And last years, after the credit crisis, they removed this margining and the monitoring of the margining, and also they amended secretly the contracts and the systems. And I think that's, yeah, we can prove that because we have the evidence. And in 2016, the Dutch banks, ABN AMRO, Rabobank and ING retroactively corrected their balance sheets over the years 2014 and 15. Rabobank also corrected the balance sheets retroactively in 2014 in respect of the year 2013. And given the whole process, the whole scenario, that's also the title of the book, Beursbank Scenario. I'm convinced that it's a scenario and it's not the explanation that they gave. I will tell you about it later. And the retroactive change or amendment of ING in 2016 in respect of the year 2014 was 186 billion euro. So you can imagine how big all the interests are. I also found very recently in December 2020 a reparation royal decree, which I didn't know, and I couldn't know because it's called a reparation decree. And normally we do not read these decrees because it's in respect of the reparation of the amendment of the Dutch Supervision Act. And it's only technical changes like that there's a reference to subsection 2 and it should be subsection 3. So and there are a lot of changes because of the implementation of MiFID and all the financial regulations. So there are also a lot of reparations, but normally we do not read this. And in that royal decree, I found the implementation of the section 80, subsection 7 of the Basel decree, the international, the European Basel II decree, retroactively also in 2008. And in the notes to this article, yeah, the legislator is complaining, and the legislator is in this respect the Ministry of Finance, is complaining because of the fact that we hadn't implemented this article in the Netherlands together with Denmark and some other countries, while other countries has, and it is the counterparty risk in the group, the risk weight of 0%. So, well, sorry, it's very technical, but I just name it. And if you have questions in the future, contact me. But that's also, for me, evidence that it's an international scam, which they repaired as of 2008 with the IAS 39 and also afterwards with the IFRS 7 and the IFRS 9. and also the EMIR regulations, and it's all related to the collateral. To make the actual situation of 2008 in line with the needed situation, well, I think it's it was a whole scenario European. Yeah, the initial and the variation margin requirements. Paul explained it already. In 2017, the Dutch AFM, it's like the FSA of the FCA, it published a report, and it said that the statutory requirement is not applicable to interest rate swaps in combination with a loan. And well, I asked them to rectify that report, and as from 2015, continuously, but they refuse. And well, nowadays I know that they used it to change the balance sheets, and it's the market-to-market value, the margin that they used to set off against the market-to-market value. So they don't want to change that report. So this is my a summary of my reaction to the former speakers. Well, I will have a short story, I hope. According to a brochure, a standard brochure of ING Bank of March 2009, the golden rule of balance sheets, which means finance short-term assets with short-term debts and long-term assets with long-term debts, is essential. The bank points out that to its customers that the financial crisis of 2008 has clearly shown that long-term investments should be financed with long money. Although short money is normally cheaper, its availability is more uncertain. It's published on the internet. What banks like ING fail to tell their customers is that it's their own violation of this golden rule in their funding that led to the liquidity crisis. In the last century, banks abandoned the golden rule of finance and started lending as much money as possible with a little capital and liquidity as possible. Although it's well known that banks fulfill a social function, shareholder value has become the guiding principle. It was no longer the customer who was central, but the profit of the shareholders. And in the credit crisis, this led to the socially undesirable situation in the Netherlands that in August 2008, ING paid out interim dividends to its shareholders, 95% of whom were outside the Netherlands, while the bank began a few months later, at the beginning of 2009, to charge a so-called general liquidity surcharge of about 1% to all its customers with a floating rate loan. In the middle of the crisis, both SMEs and public bodies had to pay an additional markup on the initial agreed debtor surcharge. And this surcharge was increased in the following years to 3% and higher, sometimes even up to 6%. And banks didn't distinguish between floating rate loans whose interest rate risk was hedged with a swap and loans without a swap. In a conscious quest for profit, banks stopped offering fixed rate loans, but rather sold derivatives in combination with variable rate loans to these borrowers. And banks presented the combination to the client as equivalent to receiving a fixed rate loan, but the banks did not disclose the higher profits it was making from this sale. I think it's already explained, and did not disclose the risk inherent in derivatives. Although the swap shouldn't protect the business owner or the organization from increases in interest rates of the loans, they closed with the bank. The flip side of the swap, falling rates, exposed the clients in question to additional credit risk caused by the market-to-market value. On August 3, 1995, the Dutch Central Bank issued risk management guidelines for derivatives, OTC derivatives. And the rule set out that two forms of liquidity risk may arise in derivative activities. The first form concerns the possibility that a bank cannot reverse a position it has taken due to insufficient market depth or market disruptions. The second form of liquidity risk is the risk that the credit institution is unable to meet its payment obligation by a due date. And according to these rules, both risks had to be viewed by management in conjunction with the bank's overall liquidity management. And Dutch Central Bank prescribed that the bank, when preparing a liquidity plan, had to consider whether it could resort to other markets and whether it had sufficient collateral available to continue its derivatives business under all circumstances. And if banks had complied with these rules of the Dutch Central Bank, and Dutch Central Bank had properly supervised the liquidity management, the liquidity shortage would have come to light much earlier. And now the prudential regulator failed in the years before the crisis. The market conduct regulator AFM could have intervened. Until 1999, it was not possible in the Netherlands to trade in financial instruments outside the regulated markets. And as from 1999, it became legally possible for banks to conclude OTC transactions with clients. And as from that time, and still required under applicable Dutch law, banks need to obtain liquid collateral in the form of cash or securities, highly liquid securities, for any out-of-the-money movement of interest rate swaps held by sophisticated or non-sophisticated clients, and are required to monitor this called margin on a daily basis. And since the margin requirement was not attractive to banks, since they had to ask for eligible collateral, so no one would conclude a swap, banks decided to provide the collateral by themselves for the account of the clients. The bank provided cash collateral to their clients through an extra loan for daily margin calls. The document package for that, for example, ING sent to non-sophisticated swap clients, contained a loan agreement for margin to collateralize the swap. And this margin requirement should have prevented banks from getting a liquidity problem. However, by lending the liquid eligible collateral by themselves, banks violated these regulations for decades. And the regulator AFM, under MiFID, not only responsible for the supervision of investment services, but also for collateral management and investment credits, did not intervene. And the consequences are now history. And this additional loan was, as Steve already explained, linked to the mortgage of the clients, although the client was not aware of this higher exposure and, more important, had no interest with such higher exposure. As interest rates kept falling in the market, the required collateral for the derivative kept increasing to the point where the bank could not longer make additional free loans. Banks did not attack that problem by imposing liquidity penalty rates, but they required also additional repayments, which caused so-called overhedges, demanded additional mortgages from the borrower, or terminated the derivatives as well as the well, I think all these consequences are already explained. And the combination of record low interest rates in the European market in the credit crisis and the lack of prepayment options became fatal to a large number of SME clients and public bodies. And moreover, it caused a capital and liquidity shortage to the banks. To falsify, improve its reported capital positions and hide the liquidity shortage, banks decided as from 2008 to stop reporting the cash collateral loans they had extended. This was a well thought out scenario. And to facilitate this massive reporting fraud and corruption, banks stopped providing swap customers with an access to the reporting system and see the collateral loan amount drawn and deposited in their margin account. The maximum amount as agreed in the additional loan in respect of collateral was administered as margin to cover the market-to-market of the interest rate swap on a daily basis. ING Bank, for example, winded down its reporting system at the end of 2012 and stopped reporting to the customer the amounts of their swap collateral loans and their designated margin accounts. And moreover, well, I will explain later that I reported this closure.
Hester, I have a suggestion. Forgive me interrupting you, Hester. This is extremely interesting stuff. I need to try to manage the time a little bit better than I have done. It's entirely my fault. We would very much like you to speak again, please, particularly in relation to an event I have in mind. Is it okay if I ask you please to come to a conclusion in a couple of minutes time and then move on to the next part of the program, if that's okay with you? This has been really, really interesting stuff. Thank you.
Yes, well, maybe you have to choose. I have we won our litigation with the higher court and the Supreme Court. I can explain that. So I can explain the SNS situation where the fraud took place.
Yeah, they've clearly got a huge amount of extremely relevant and very, very purposeful content. I think what we should do is speak with you next week and organise you to have another speaking slot as soon as possible in another event like this. That I've mismanaged the time. We had a very short speaking slot for you, you see, and we needed to allocate more time to you. We won't be able to do that. So if I can invite you just to bring your thoughts to a conclusion, and then we'll move on to the next part of the programme, if that is okay with you, please. Thank you very much. Thank you.
Yes, well, yeah, well, I will. I think it's good to know that I reported it to the AFM as from 2014 continuously, and I sent a lot of letters to the managing directors of the AFM. As of 2012, our firm is representing victims of banks misleading practices in the Netherlands. In proceedings against ING by a client of Buys Legal, both the Court of Appeal in 2015 and the Supreme Court in 2019 have confirmed that the interest rate swaps in question were concluded under influence of error with regard to the harmful effects of the daily monitored market value of derivatives and the free loan cash collateral provided by ING. The Supreme Court confirmed that the derivative contract was voidable as a result of error and ordered ING to compensate the individual client, but the court case did not address issues related to the ING financial disclosures made to domestic or foreign investors. And I think it's interesting that this Supreme Court decision is completely ignored in the Netherlands by the regulators and also in the universities where the people from the attorneys from the big firms work. While the Dutch judge at the court confirmed the relation between the liquidity problem, the liquidity risk, and the higher interest rate in relation to the market-to-market value and the daily margining. So I think that's interesting if you link it to the former speakers. That I think it's interesting to know there's already
most certainly it's all extremely interesting, and if you would be happy to come back, we'd love to hear you speak further. For the moment, let's bring that section to a close. Hester, we are very grateful to you for preparing your presentation, and we look forward to hearing from you probably in a couple of weeks if that works for you. Hester, thank you very much indeed. Very kind of you to present tonight. Thank you. I've put a link to your website into the chat, and my colleague Alexandra is going to organise a conversation for us next week. What we're going to do now, folks...
Sorry to interrupt. Maybe it's interesting. My Twitter account, you can find all the information. It's publicly disclosed. So
perfect. Please do put it into the chat, Hester. That would be very, very helpful indeed. You've come very highly recommended, and I can see why. Superb. We're now going to go straight to Peter Crowley. Peter's got a just-a-minute round, and the just-a-minute round is very simply, literally up to 1 minute maximum. It's an idea we've borrowed from the BBC Radio 4 programme called Just a Minute. So up to 1 minute, please, Peter. Please don't go beyond that. Please don't go beyond that. Then we're going to hear from Craig, then Clive, then Andy Verity. So Peter Crowley, please share with us the essence of what you really want to say in no more than 1 minute. Thank you very much indeed, Peter. Thank you. Off you go.
Right. Number one, well done, everyone. You may feel that you've been totally screwed over and you're struggling against enormous forces against you, but you are immensely powerful. You have kept interest rates in this country below 1% for 10 years. You have shown the financial buggers that are running this country that you make a difference. That's number one. Number 2, Andy has kindly pushed my big book. Has everyone seen the cartoons?
You can see it now.
This is what happens when you go into GRG. I'll send you if we put the link up, I'll send anyone a free cartoon book who wants it. Number 3, look very closely at Her Majesty's Treasury. I haven't got time to put it on now, but follow Smooth Regulator tomorrow, and I'll put on all my stuff about Her Majesty's Treasury, who are the real people who are buggering you all about. End of chat. Carry on.
Wonderful, Peter. That was literally within a minute. That was absolutely perfect. Exactly what we want to hear. So, Peter, thank you very much. Alexandra, please do liaise with Peter and ensure that what he just referred to, the Smooth Regulator link regarding the Treasury, gets circulated amongst our community. Superb stuff. We're going to go straight to Mr. Clive May. Clive, you've always got lots to say. This time your challenge is to say it in less than a minute. Go for it.
Evening, can you hear me?
We can.
Clive.
Splendid. So I was a victim of a hidden credit line subject to Royal Bank of Scotland invoice finance. The credit line was placed against me without my knowledge. One of my suppliers, he was a client to RBS Invoice Finance, had credit insurance on us. What the bank did, it was an invoice discounting facility. We didn't even know about the facility. They placed that liability against me, which caused me to go into GRG and in the end bust our company. So the hidden credit line, not just in the IRHPs, exists in the RBS Invoice Finance. End of.
Thank you very much indeed. And we're going to hear
He's
a lot.
bloody briefer than I was.
He was. He's obviously as fast as his bike. Boom, boom. What we're going to do now then is say thank you very, very much indeed to all of our speakers, and then we're going to open things up for those that would like to stay for a little longer and have part of a general Q&A conversation. So can we please put our hands together and show our appreciation to all of our speakers, many of whom have prepared at length, and it really does show. So that's absolutely superb. Okay, so the formal part of the session is now ended. We'll keep the session going. We'll keep the recording going. So remember, everything we're about to hear is going to be out there in the world of the internet in the not too distant future. Would anybody like to wave at me either literally or digitally to let me know there's something you'd like to say? Please do that. Thank you.
It's Jess here.
Hi, Jess, go for it.
Just interesting to know how many people were actually kind of into forced bankruptcies and into liquidations through this mis-selling of these products. Has anyone got an idea of that?
How many people have been forced into bankruptcy through the mis-selling of? Does anybody have data on that? And if not data, does anybody have an understanding of what it might be?
Mike Lloyd, can you unmute?
I think Steve might have the answer to that.
Steve, any comment on the scale of the problem in terms of number of bankruptcies? Steve Middleton, I guess we're talking about.
Yeah.
Steve, you're on mute, sir.
No, I was trying to unmute. Sorry, I can't. I could get you data. I can't give you exact data. What I do know is people going into the review and in GRG, probably at least a third of them were insolvent or in administration. So you'd probably be talking of 10,000 at RBS, at least 3,000 or 4,000 at RBS alone that were in administration or insolvent. I would imagine across the board, across the various companies, just in terms of those who were allowed into the review process, between a quarter and a third of those. So effectively, the bank admitted wrongdoing and then paid monies back to themselves during the administration process.
Yeah, I think the reason that I kind of bring that up is the insolvency abuse and the rise of it over the past 10 years is their preferred mechanism to padlock the business or padlock someone individually, of which you've got no real rights under the Insolvency Act. And that Insolvency Act, which has been around for 40 years, just absolutely abuses and asset strips businesses and properties. And I think that's a huge expose which we're kind of working on as well.
I think there's two things I'd say on that, Jess. You're absolutely right. And the people who are pushed into administration or insolvency have not been looked after by any of these reviews or anything that's happened. Nobody has worked to redress them or their creditors who will again have real basis for claim. The other big issue that needs to be looked at is when the Asset Protection Agency was set up, 360 billion of loans from RBS went into that scheme. RBS were avidly selling these hedge products to people for putting them in that scheme. So in other words, loading them with credit, loading them with debt, before giving them a haircut in the asset protection scheme, and then shortly after busting them. It's a huge issue.
Yeah, I mean, it's an absolute business scam. I mean, look, you know, I think this country in Europe has been actually on its knees economically. We know what the landscape is: recapitalisation of banks and asset stripping, and really, the asset stripping is down to people, their houses, their businesses. They've got really down to that, you know, to that level, because as a country economically we have struggled. So our lawyers, our accountants, regulators, they're all in it. It's all a scam. And I'm just saying that the insolvency abuse is one of their preferred methods. I totally understand. Thank you very much for a very informative event today. But I think going down the fraud angle, absolutely. This country, in my research, has never criminalized an insolvency practitioner or an accountant. No one has successfully had a professional negligence claim in a class lawsuit action, which is very common in the US. And people get thrown into prison into the US on Chapter 11 bankruptcy. We don't have it because it's a scam.
Thank you very much indeed. Hester, back to you. Thank you, Hester.
Yes, sorry, I have to unmute. Yes, I would like to add that in my view, I think that all the international money laundering scandals now, that it's all based or in relation. It's an how do we say that? It covers this bigger problem. So, for example, I discovered that Danske Bank had the same problem like our ING bank with its daughter company, the Estonian branch. And if you look into the, I think 2014 balance sheets, the first announcement was that there was 30 billion euro anti-money laundering scandal. And if you look into the balance sheets, the positive value of the derivatives are 30 billion. So in my view, it's all to hide the bigger money laundering scandal, removing the margin accounts and also administering the margin in the bank accounts.
Hester, if I'm Andy, do you mind if I just reply to that?
No, please do. This is fascinating.
Hester, no, thanks for that. I think one's got to understand also the introduction of the money laundering. The money laundering acts were actually brought in because the governments, they wanted a piece of the action. Yeah, that's how they done it. Right? They wanted a piece of the action. The UK is the most corrupt country for white collar crime. It still holds 50% of the tax havens around the world from the actual kind of legacy of the British Empire. Now, we are being run by crooked, we know bankers and lawyers, it's an absolute scam. Insolvency abuse is their preferred method, or one of their preferred methods. Class lawsuit actions are big business in America. And it's all about money at the end of the day. They have taken everybody's money, either through assets or through one shape or form. And I think a dual approach of legislative changes, which is what the TTF has successfully kind of in pigeon steps doing, but also more on a negligence claims financially through class lawsuit actions may be something that we could collaboratively work together on. I mean, this is a David Goliath battle. We know it. It's not easy, but the language has got to be about trying getting reimbursement of money.
Thank you very much. Please just jump on that, Steve. Go for it. This is again a very interesting line of thought.
Jess, I don't know if you've looked at this, and I don't want to sound completely conspiracy theorist, but one of the concerns I've been looking at and speaking to Anthony Stansfeld about is I was trying to find out why, I've been involved in lots of cases where fraud allegations have been made about credit lines, signature forgery, up and down the country. I've met with various police forces. I know loads of people who've got their action fraud references, and nothing has ever moved forward to be investigated and prosecuted. Now, around the time of the swap mis-selling scandals, there would have been thousands of allegations on these matters. But what I hadn't realised is that just before or around that time, they'd centralised all of the economic fraud investigation and policy down to the City of London Police. Now, the City of London Police report to the City of London Corporation, not to the Home Office. So you have 43 police forces, 42 report to the Home Office, 1 reports to the City of London Corporation, and the City of London Corporation, well, within the City of London area, the square mile, you have approximately 9,000 residents and around 250 to 300,000 workers. 90% of those people are in the finance industry. Now, I've been asking what conflicts of interest policies there are in place between a police force that is effectively almost employed by the banks and continually lobbied and influenced by the banks, and the national policy for economic fraud. And I've just had responses in the last week to there is not one single conflict of interest check from the Home Office or within the City of London.
Well, if it's of interest, Stephen, without seeing the thunder of a great individual, Anthony Stansfeld, I think he said it quite pointedly. 900, I think it's up to around 900 million, or even more, it's billions, of white-collar crime fraud, and they have around 35 officers.
190 billion a year, Jess. 190 billion a year.
Yeah, it's 100. Okay, so the point being is there's around 35 officers looking after this. Look, we know what the landscape is, that it's corrupt right to the very top. Our progressive discussions with what we have, even from an international perspective, we know what the landscape is. I think us adopting trying to get into more of an American style of class lawsuit actions, and there are firms out there who are jumping on as business class assets. I'm a chartered accountant myself. I commercialize businesses. There are business asset classes out there where lawyers want to jump on and go and eat other lawyers and eat other on a class lawsuit action. You know, you give them 30, 40%. There are business asset classes out there of which is driven by the Canadians, by the Americans. And if we could somehow collectively as a group identify our class lawsuit actions as a business class asset, this may attract more of a kind of motivation.
Just on that point, I'm dealing with 2 firms in the US at present in Washington, one of whom has prepared a confidential file for the SEC on banking issues in the UK, and the other who is a not-for-profit who is actually representing a UK whistleblower on a pro bono basis currently. These people are quite shocked by what is going on in this country, is what I will say.
I'm also, they're probably thinking that as a good opportunity. I mean, we're talking about class lawsuit actions against the Ministry of Justice, the Insolvency Service, the governments, not just individual firms. You know, because it goes right to the very top. And I think it would naturally only appeal to an overseas country. And I think naturally the Canadians and the Americans who are legendary at doing this is something they're just there to go and basically make as much money as they can. They don't care which country, so long they have a compelling evidence regarding, and you've seen this play out. You've seen the PPI scams, you've seen VW with green emissions, you've seen, and a lot of these people may settle out of court. So I'm just kind of throwing it out there to us as a group to think of ideas and more of how we can, in a way, use it as a business asset class.
Can I just come in there? Because that's really interesting. The reason that's so interesting is because I've heard many people say that it's actually very difficult to get a UK law firm to do anything like the kind of thing that needs to be done, because it would have to be a big law firm, and by definition, it would be a big law firm that was plugged into all sorts of cases, and there are all sorts of conflicts of interest. So are you basically saying, Jess, that, and Steve, that an overseas law firm would approach this with a greater sense of purposefulness than would likely be the case if it was a British law firm? Is that what you're saying?
I'll give you an
absolutely.
Sorry, Jess. Yeah.
Absolutely. Look, you know, the American way of life, and I'll spend a bit of time out there, okay, it's about money, and it's about, and that's not a bad thing. Where they would seek opportunity, I think that's what they would do. But the way they work is they have big hedge funds which actually get family offices, high net worth individuals to use class lawsuit actions as a business asset class, and they get around, you know, whatever, 15-20% return on their money. So they're driven motivationally to ensure that they succeed. They, of course, will do their due diligence. They will ensure either open and shut, you know, they've got 90% confidence levels that they will win. I don't think there'll be any success in using a British-based firm, if it's Magic Circle or the best QCs or the barristers, because no one's going to bite the hand that feeds them. I mean, I don't see that logically. I think where I do see it logically, it will be a very attractive business asset class for an outside country, and I think the Canadians and the US have got a big appetite for that sort of thing. Because look, they've probably done as many class actions as they can in America. Now they're probably looking overseas to come and do it. So it would be good that we could collectively somehow, across the many different business asset classes, I mean, we could develop in a way is to commercialize all the wrongdoing that has happened over the past 10 or 15 years, all the victims, and I feel sorry for the people who've taken their own lives. This is murder at the end of the day. We should also be looking at the Proceeds of Crimes Act, how we can criminalize them. I've spoken to a lot of QCs and barristers, and it's the same response. It's usually in Latin, and it's usually no one's ever done it before. And my response to them is, well, doesn't that tell you one thing logically? It's a scam. Yeah. If in 20, 30 years, our legal regulatory system does not allow the imprisonment of some accountant or a bank manager, or it's just, okay, we've had a couple, some low level, but this is on an industrial scale. So therefore, the amount of people who should be either in prison should be on an industrial scale. So I'm just making those observations
I think we've got to think outside the box on these things. That case I mentioned in Ireland, the Irish people have been absolutely destroyed by the banking issues. In Ulster Bank, there's been over 1,000 suicides of developers and builders in Ireland, and that's a huge amount. The churches have been heavily involved, and the banks have been lying about what they're doing, how they're lending to the churches. And what we have at the case we're working on at the moment is we have human rights lawyers, because virtually all the lawyers in Ireland work with the banks or on the bank's panels. So we've got human rights lawyers, and they have just succeeded in getting legal aid for one of the victims we're fighting for. So the case where we're taking on Ulster Bank, RBS, Bailey, the FCA and the PRA is now fully funded by legal aid. And it's that approach. I spoke to the lawyer and he said to me, Steve, if we can get this, they've never faced this before. Fighting us on legal aid, we can go as far as we need to go with whatever we do. And this is a guy who deals with a lot of the trouble issues over there, with some very, very big cases, group actions, you name it. So we have to find different ways forward. In the UK, you can't take on, I've gone up in negotiations against, Freshfields and Herbert Smith Freehills and all the various ones, and been successful in mediations against them. But I couldn't take them on in court. I wouldn't stand a chance. And I couldn't find a firm that could take them on in court. Yeah. And if I did find a firm that was prepared to take them on, they would want to be the next Freshfields or Herbert Smith Freehills. So you're undermined at the start with every one of the legal actions you can bring in the UK.
We're going to go to Hester, then we're going to go to Peter Crowley, who I think would like to say something. Hester, back to you. And also I can see Alex Varley-Winter. So Hester, Peter, yeah. Alex. Thank you, Hester.
Yes, I think I have more question, and it's not for now, but I think it's good to see how it worked out in the UK with the for example, ING had to sell Nationale Nederlanden as part of the state aid. And what we see with the bank insurers was that it was a compensation model. So they used the liquidity or the assets of the insurer also as liquidity in the whole compensation model. So, and what happened is that, for example, SNS Bank, SNS Real, the insurer, was sold to Apollo. First to Ambang, a Chinese insurance company. The CEO is now in jail for 18 years because he used the premiums of the policyholders. Then it was sold back. It was bought by Apollo, And if you, the name of the anti-money laundering file of ING Bank is called Houston. So related to Houston, we have a problem. So yeah, there is a pattern, and I think it's good to look into the insurance models with the banks and to see what happens. I don't know how that worked out in the UK, but it can be interesting if it's a European pattern.
Thank you very much. This is getting more and more interesting every minute that goes by. Let's go to Peter Crowley. Thank you, Peter. I'm pretty sure Peter wanted to say something.
I'm unmuted. Can anyone hear me?
We can, Peter, yeah.
Apologies. I cannot remember the name of the guy who wrote the book. It's called Waiting for the Sheriff in Ireland. I think it's worth putting it across. And he said, I thought he'd attended about 50 evictions. And what he'd attended was about 50 funerals for people who've been evicted after this kind of banking crap. We think we've had a problem. In Ireland, it's a bloody nightmare. I went out there and gave 3 talks, and found that there's probably no way through this bloody stuff because the establishment is so well established and it's so parochial, and it's very much rigged. And lots of people lost their family holdings and etc., which is why their economy's buggered. But it just reinforces the fact that if you don't have honest people, it just folds down and folds down and folds down, and at the end of the day, everyone loses. There is no way out of dishonesty apart from becoming honest. Thank you. Over to Andy.
Thank you very much. By the way, Peter, I've put a note in the chat. Could you elaborate on what you mean by white shoe firms? What is that?
White shoe firms, American firms which have a high integrity. They're the top end of the legal profession in the US.
Thank you. I've never heard that phrase before, and I've put a link to the book in the chat. I think it's the right one. Please check for me, and if it's not, tell me, and I'll find the right link.
The cartoon book is not there, but hopefully everyone's got my link, and I've got a great big pile of them, so I'll post them out to you. Sorry, with the cartoon book, I'm old. I'm old technology. I'm not.
He means Tom Darcy's book, Pete.
Tom Darcy. Thank you. Apologies to Tom. Tom has lost his life and his livelihood, and he's still, I hope, still bloody fighting. And I think it sounds like he's still working with Steve.
Yeah. I've not spoken to Tom for a while, but I've met him. Yeah, and obviously I've read the book. Yeah.
There are people in the industry who fight their bloody guts out.
Right.
Tom Darcy is one of them.
It looks like
at least read his book. You can't. He's lost everything.
It looks like I have put the right link in there because it's got the words Tom and Darcy next to each other. Just before we go to Alex Varley-Winter, what you just said, Peter, made me think of something. I don't really know how to describe this. Just bear with me. What I'm trying to think is that if our generation doesn't do all we possibly can, our kids, grandkids, are going to grow up into a world with a toxic financial services sector. So we need to think about, and these kind of conversations are encouraging us to think about the big intergenerational issue here. Maybe it could be our generation that really, really, really does fight back as hard as we can to the kind of malpractice, malfeasance, misconduct, mis-selling, regulatory capture, regulatory failure, all the stuff we've been talking about, and to do so with the intent of, frankly, making it better for the people that are going to come after us, because it's going to be a big effort.
Great comment, Andy. I will respond in 2 ways.
Please do.
Number one is that I think integrity is integrity. You can't argue with it. You know when something's integrity, and you know when it's not. You know when something stinks, and you know when you want to move away from it. You know when someone's crooked, and you want to move away from it. We all know what honesty is, but we sometimes pretend that we don't. Number two, my future writings are going to be on crookedness, because I've seen people say, these are the standards, these are the things we want to do, this is our, and I am old enough, 66, to think, bollocks. I'm now pointing out crookedness and letting people see crookedness, because that's more interesting and it's more to the point. Now, there will be some people who pick up my books and say, ha, I can use that to screw people. Unfortunately, that's tough, but that's where I'm going.
Thank you very much.
My next book will point out more crooks and crooked ideas than you've had the hot dinners.
Thank you, Peter. Thank you. If Alex Varley-Winter is still with us, Alex, would you like to share your thoughts, please? Thank you.
Yeah, I was just thinking about the Chris Arnold case in Ireland, and yeah, whether there needs to be more reporting done around it, whether I should be reaching out to people, because a journalist that I know that has often reported from Northern Ireland has said that constantly complains about how the mainstream British press just doesn't cover stuff adequately over there. So it may be something where you need to be a bit more effort on outreach about it. So it came to mind. And on the point about integrity, I do think it might surge a bit more on the environmental side as well. Banks are just not being honest about climate risk, and how more and more protests are coming up on that. So yeah, there's sort of, in terms of different movements having the same ideas about trying to promote honesty and full disclosure, there seems to be more of a surge among bank shareholders and things like that as well towards that.
So thank you very much indeed, Alex. And by the way, for those of you that don't know, Alex spends hours and hours a week on a purely voluntary basis, being the Transparency Task Force head of investigative reporting and media relations. In fact, can I please invite you all to quite literally take this opportunity to thank Alex for what she does. She puts out a superb blog every week, well researched, well written, probing, challenging, constructive, and it's all purely voluntary. We are blessed to have Alex with us. We really are. Thank you, Alex. Thank you very much indeed.
Yeah. Can I have a quick word with Alex? Am I still on?
Yeah, you are, Peter. Go for it.
Yeah.
Go for it.
Very quickly, I think it's very important that we look at environmental things from environmental professionals. I think too many people are sort of steaming into the environment things and saying, oh, I can do this, I can do that. I think it's a professional issue. I also think it's a governmental issue, at which point I'm very glad to drive it, but it detracts from professionalism in other areas. And maybe I'll pick this up with Alex offline.
Yeah, have a conversation. Would anybody else like to take the opportunity to share a thought? I could see Paul Clark nodding a fair bit when we were talking about Ireland. Paul, let's hope.
Take me, Paul.
Well, hopefully we need your volume working, Paul, because we can't hear you still. So there's a setting on your computer that's not quite right, Paul, and that's why we can't hear you. I think we're still struggling to hear Paul. Not to worry, Paul. We'll fix it for next time. Would anybody else like to share a thought? Let's bounce back to Andy Candy, who opened the session up. Andy, back to you.
I'd just like to thank all the speakers this evening. It's been a fantastic event. Really do appreciate it. It's been in the long grass for far too long, and the implications of it across the board, I think many people will have seen tonight. It's not just a case of mis-selling. It's not just a PPI thing. The complexity of it and how far it extends into our culture is just, astonishing. And it's something that needs to be dealt with and got hold of very firmly, and the establishment aren't willing to do that. They've proven it with successive governments. It's not a political thing because it's gone through all of the parties, but no one wants to sort it out and no one wants to deal with it, and they're all trying to keep it kicked into the long grass. And the evidence that's there in abundance in the bank files, which Hester's 9-year investigation has set out in detail, in the Netherlands and over there, and Steve's done, and Paul's done, and Peter's done, and it's it's astonishing. These people aren't crackpots, they're not conspiracy theorists. It's absolutely hard and fast information, and everyone in the banking industry knows it's going on at a certain level. This is top down. It's not rogue traders. It's not rogue individuals. It's a systematic process of deceit and asset stripping of UK businesses. And that's the same across Europe. I expect it's probably similar in the US, although the sanctions there are far more stringent if they get caught. But it's just astonishing the level at which it's perpetrated, and certainly in the UK, that nothing gets done about it whatsoever. I mean, how you can have a police force controlled by the City of London with special police constables that are actually bankers and auditors and the FCA, and they're all seconded into each other's agencies. I mean, it's ridiculous. I mean, it'd be like a murderer employing all of his family to sit on the jury and as the judge and the evidence providers. It's ridiculous. I mean, it's such a hung court, it's beyond a joke. So yeah, sorry to go on a bit of a rant, but it's it needs to be tackled.
Andrew, thank you so much for that. And it was when you started off the event, it was really kind of informative. And I think Andy, if I may, I'll be very quick. I think the whole purpose of the TTF is, what I've seen is that you've got many silos, right? You've got people who want to do exactly, you know, you've got forged documents, you've got pension scamming, you've got the event that we had tonight, you've got what we are discussing about putting in insolvency abuse as a small group. All these add up to basically the total corruption within our system. I think we've also identified we have to start thinking about further down the road. Oh, sorry. Now, how can we use outside people like the Americans and the Canadians to create business asset classes? Because I think once we get, and we already have successes of class lawsuit actions, a lot of them can settle outside. There is no leverage for the people who've lost their wealth and lost their lives. There is no kind of how can you get your money back mechanism, because it's so corrupt at the very top. And I think one of the key things that we did touch upon, I think around 2 months ago, was I'm from the advertising PR world, and we said that we were going to create a Netflix documentary, kind of with around 20 minutes of not people's stories about specifically around their stories, but identifying you know, good content which will create a documentary film series which we can add through YouTube, BitChute, all the social media campaigns, because we've got to create, I think, a lot more kind of awareness around these particular topics. I hate to say this word, but we've got to make it look sexy for the Joe public to kind of understand what is happening out there. And I think there has been just a couple of good documentaries. There was one which I think was made for less than £10,000 about the full signatories, and it's on Netflix, and I can't quite remember what it's called. It's a spider's web. It's called the spider's web.
Yeah, I've seen it.
And it's you know, it's that if we had around 10 of those as a consistent, you can even call it, you know, the TTF documentaries, you know, if we create that sort of movement in this social media world, we've got to use all the tools that are out there for us to continue to create this brand awareness, to make it a better world for the next generation, right? Because we are the generation who got stung. We are the ones who are a bit getting older, and we've lost, you know, we spent 10, 15, 20 years of our lives doing this. So we've got to have some sort of outcome. And the outcome is, okay, we can go and imprison around 4 or 5 bank managers. I don't think that's enough. You know, what we really need is a $100 billion class lawsuit action against the Ministry of Justice. Yeah, or, you know, a $50 billion claim against the Insolvency Service. It has to be headline news. And I think we've, you know, got to kind of have that, you know, sharing of ideas amongst this group as well.
Jess, thank you very much indeed. Jess, I put the wrong link in first, then I put the right link in to fix up a conversation about this macro legalistic approach. I would appreciate talking some ideas through with you, please, Jess. Fix up a call. We're going to go to Nigel Cairns, and then we're going to go to Hester. Nigel.
Hello, can you hear me?
We can, Nigel, yes.
Yes, thank you. I just wanted to make a comment about one of the topical things that's been discussed with the capture of the specialist law firms. And mention has been made of magic circle firms and the specialist big firms in London that cover regulatory action. With many of those, you'll find that almost all of the partners in the firms are pre-instructed by most of the major banks and will not act for you. But I think the problem actually is much worse than that, because I think it comes down to a regional basis with big firms of solicitors that have practices specialise in banking and regulatory law. So I think a lot of people face brick walls at a much earlier stage than you might think in terms of an original complaint or an investigation into a case that they may have, which probably extinguishes an awful lot of the cases before they ever get anywhere.
Thank you very much indeed. More and more interesting stuff. Back to Hester. Thank you, Hester.
Yes, well, I think it's good to see whether we can cooperate in some
Yes,
well, European or claim, because I think it makes sense that it must be huge. And also I agree that we really need to change the system, and that it's not for us because, well, we are getting older, but that it's really a preferred system, which is now for 20 years or 30 years, it just ruined the whole economy. So I fully agree. And don't be disappointed about the corruption in your country. In the Netherlands, we are very good in pointing at other countries like Malta and Hungary and all these kind of countries. But I can tell you that we are very corrupt, and we have at this moment we have a parliamentary crisis because of discussions about integrity. So I believe in a new world and in transparency, and I think it's just a matter of time.
Hester, thank you very much indeed. I'm going to start bringing the session to a close, but just before I do, I just put into the chat, Hester, a note that the Transparency Task Force is a member of Better Finance. Now, many of you won't know Better Finance, but Better Finance is a Brussels-based, pan-European, EU funded, not entirely, but with proper serious EU funding. We are associate members of Better Finance. We're extremely proud to be part of that pan-European organisation. And Hester, it may well be that once our conversations develop, we might be able to ask for some support from Better Finance for the kind of things that would really, really move the dial, so to speak. Folks, I'm going to bring the session to a close by coming back to a point I was making earlier. Do you remember I was talking about violation tracker? I just want to recap on a key point here. What I said earlier, as you may remember, I said that it is totally and utterly unacceptable that the worst industry in the world when it comes to behavior is financial services. This data is telling us a story. The data isn't lying. Cognitive dissonance, the propensity for people to ignore what the facts are telling them, we must not let it happen. We must not allow us to be distracted from the kind of massive brand identities of these huge glossy organizations, the banks. The data is telling us that the financial sector is riddled with all kinds of conflicts of interest, all kinds of malpractice, malfeasance, misconduct, mis-selling, scams and scandals. And the only way we can really have any chance of doing anything about it is if we learn how to work together. That has got to be the formula for success. There are so many people on this session. There are so many people within the TTF community and other communities, nothing to do with the TTF, who do have the knowledge, the insight, the experience, the courage, the motivation to do something about this. I'm frankly fed up talking to people who are in tears because they've lost money they cannot afford to lose. I'm fed up talking to people who've lost loved ones, or whose children have started self-abusing because the mum and dad are so stressed, yeah, because of what's happened to them. I'm kind of at the point emotionally where it's just intolerable. So I, as one individual amongst many, many other individuals, I'm going to continue to do all I possibly can to make a difference. And everything I know about what we're talking about tonight tells me the way forward is to learn how to play to everybody's strengths. You know, Hester's legal brain, Jess's social media mindset, the sort of forensic analysis from Steve Middleton, Paul Carlier and others. We've all got strengths. Let's figure out what they are, and let's form a dream team of opponents to an opposition that has got so comfortable in its own power and its own self-importance that they really would be rather surprised if the opposition is able to fight back. And that's frankly what we now need to do, folks. I salute you all. Thank you very, very much for being part of another Transparency Task Force event. I've got no idea how good we are, but I do know we're trying as hard as we can, and I salute you all. Thank you very much for being part of this and part of us. Thank you very much.
Thank you.
Thank you, Andy.
Good night, everybody. Have a wonderful weekend. Thanks all.